companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Equity futures this morning, and good morning on TV and radio. We look like this. We're negative by more than 2% on the S&P 500. Taking back yesterday's rally on the NASDAQ 100, we are down by 2.8%. This Federal Reserve with an outlook that includes higher interest rates. They hope lower inflation, but also higher unemployment. That's got everybody's attention. And for some, that's too constructive. Almost fantasy land for the likes of Scott Minerd and Bill Dudley too, the former New York Fed president. So that's the equity market. It's yesterday in reverse in the bond market too. We look like this on 2s, 10s and 30s. Yields in yesterday, up today by 15 basis points to 343.50 on 10s, on 2s, up 17 right now to about 336. Look out Germany too, the bond market breaking out through 180 on a German 10-year, Tom. That got your attention. It got mine too.
This is wicked important, folks. You not only look at the spread, you look at the levels. And Germany, Italy, John, today speaks volumes. The fact is Italy hasn't given it up. It's still near 4%.
Tom, that spread was inside 100 basis points last year, back through 200 over the last couple of weeks.
I'm sorry, there's way too much spread analysis and not enough level analysis right now.
Tom, I'm with you. Yeah. We have to fold all this into the FX market too, so let's take a look at what's been going on. The Swiss National Bank out with a surprise 50 basis point rate hike, a stronger Swissy. Euro-Swiss one to watch. Euro-dollar another one. Euro-dollar 104, negative a third of 1%. If we're importing a lot of inflation, we've got a problem in the FX channel for Europe. We've got a problem in the FX channel for sterling. The Bank of England's up next, Tom. This is an important one. 121.57, we're down about 0.2%. In an ideal world, you'd engineer a stronger currency to attack some of that imported inflation. I say in an ideal world because I'm not sure many people are convinced that if you get a big surprise, a big move from this Bank of England today, that you actually get a stronger currency in response to that. I'm not saying you won't, I'm just saying it's very much up for debate, and that debate is
John,
very divided.
I want you to inform us here. You've been in the room. That I perceive the Bank of England as a more fractious institution. Is Bailey speaking alone today for a committee, or is he speaking thinking of the Prime Minister under siege?
Tom, I'll say this. Whenever a central banker, a leader of a central bank speaks in a news conference, they have to try and reflect the consensus that exists on the committee. The problem is that at an institution like the Bank of England right now, there are so many different views in different directions that it's hard to form a committee, form a consensus, and then represent that consensus live on air, as they talk to us, as they talk to the audience, to the journalists. So I think that's the #1 challenge for Governor Bailey today. How much dissent do we start to see, Tom, again, around this Bank of England and the way forward? And let's not forget, I thought it was interesting yesterday that we had some dissent from someone that traditionally, Esther George, would be considered a Fed hawk, who only wanted 50 basis points at yesterday's meeting. I know it wasn't the big story, but it's something we could talk about on the path forward.
We're scheduled to have breakfast with her at the Pioneer Grill, where I'm going to have a full Wyoming. We're looking for
at the end of August.
At the end of August at Jackson Hole.
Just
right
to
now,
explain that to people.
Let's slide over to the equity markets right now. Andrew Sliman joins us, Senior Portfolio Manager, Morgan Stanley. Someone who is in equities, someone who is congenitally long and optimistic, except maybe he's not. He joins us now amid the gloom. Come on, Andrew, the gloom. There's blood on the streets. Do you load the boat here?
Look, I think there's an opportunity coming. I just think it's too early. It's the stock market, regardless of your view of the economy. My view is basically the stock market's got a hard time with 10-year where it is, given the multiple that remains on the market until we get resolution in terms of interest rates and inflation. I just think it's too early to get aggressive, but it's out there. Right. It's just too early.
Amid the gloom, what is the lesson on use of cash? We saw D.E. Shaw go after FedEx. They've amended. We saw Target with a big dividend increase as well. How does use of cash change given the gloom that's the Bremo-like gloom that's out there?
Well, it is interesting that, you are seeing companies increase stock buybacks. You're seeing insider buying. So I think there is some reason to believe that the collapse in earnings won't be there. And I think that's a lot to do with inflation, frankly, that companies can pass along their inflationary costs to the consumer. The question becomes, will they be able to maintain the margins, or will consumers push back before their costs come down? And right now that has not happened. So companies feel pretty good about their business and they're raising dividends, buying back stock. That's what's happening now. We haven't seen the collapse in margins that many of the bears have predicted.
So, Andrew, let's say that we do get a continued sell-off, as many people do expect, as the real yield, not only the nominal yield, but the real yield in the United States resets to levels that we have not seen since 2018 and earlier, depending on which measure you look at. When are we there? When do you start saying, we have baked in the depth of the pain, let's go?
Well, I think, first of all, timing. It would be nice to be a little bit later into the summer, because I suspect another 75 basis point increase will cause further catharsis. It would be nice when you guys are out having your burgers in Wyoming or whatever you said, Tom. If the Fed were to, ease up, I think that would be good. So timing first. Number two is, where did the market go? If it gets down, it's 16 times forward earnings. If we start to see 14 times, in the, kind of mid 3,000s, I think that would be helpful. Or if you saw rates back off to closer to 3%, which clearly is not happening today. We're starting to see some inflationary inputs weaken, but certainly not oil. And there's too many things driven by oil prices. So inflation backs off, rates back off, or the market comes down to a multiple that's more reasonable with 3.5%. I think those are the two scenarios. And I suspect all that will happen going into it later this summer. I just think it's too early. So you remain defensive until then.
Andrew, what does it mean to remain defensive when you have to be fully invested?
Yeah, for me, look, I think we want, so number one is, what's amazing is, what is working year to date? Energy, utilities, defensive stocks. Those are late cycle stocks. The market has told you that we're into a slowdown. The way you position as a long equity manager is make sure that your beta isn't above the market. Make sure you have plenty of these defensive stocks and energy. However, though, Lisa, is early cycle is the consumer stocks. And those have been absolutely crushed. There are a ton of opportunity in consumer stocks. And as I said before, when the consumer sentiment is at an all-time low, you have to stand up and say, the rate of change at some point is going to be, positive. And I think those are the types of stocks you want to start to prepare, do the analysis on, because I think that's the next, what I would call the next fat pitch, is to move into more of these early cycle stocks. I just think it's too early.
Andrew, are you saying that it might be time to think about fading some of the energy move then? after the monster rally we've seen in energy stocks.
Yeah, well, so Jonathan, here's what's interesting. So the utility sector through May had outperformed the S&P by 1,500 basis points year to date. Utilities are fading, right? So they have faded going into June. So I just wonder whether we're going to look back and say, we were in a recession. We're already in a recession. And the playbook would say then you want to start to fade the late cycle. If you tell me, Jonathan, the recession is, end of the year or next year, oh, then it's too early to sell energy. It's too early to, begin to reduce the defensive. If you tell me we're in it now or it's happening, then yeah, I want to get, I want to start to fade those.
Andrew, that R word though,
I know
what
that's
does it
perverse.
mean? If we were in a recession, and let's say it was right now, whatever that means, what kind of recession would you be expecting? I see that R word get thrown around all the time.
Yeah,
what kind of
exactly.
downturn would you be expecting?
Well, what we're getting. The problem with a deep recession right now is you're not getting the fundamental drop off that the big earnings destruction. Now, what scares me is you're starting to see some of these financial issues like Swiss Bank raising rates. My contention has always been ultimately, unfortunately something breaks in the system and it, kind of not a very nice way to say it, but a dead body floats to the surface. That's the kind of thing that, marks bombs in, recessions. But you're right now, as we sit, if it is going to be a shallow recession because we haven't had the drop off in fundamentals to the magnitude of a deeper recession.
Andrew Sliman, Nuanced View, as always, sir. And good to catch up with you from Morgan Stanley Investment Management. TK, a lot to think about on the energy front and elsewhere.
Well, it is. And the energy front is front and center. Certainly politically, it's front and center. John, I would not only take I thought your recession comments there were dead on, and that I would take the recession comment and split the GDP equation to the domestic equation and the foreign input equation, export imports. And I wonder if you're going to have a two-part dynamic where you get a negative print on recession, you get the gloom of a recession, but you get it with a pretty good American economy while we import so much stuff that it drives us into some form of growthy recession or
You're describing the first quarter, aren't you?
Yeah. Well, John, I mean, there's courses that are taught like this. I think Northwestern has the best source, Robert Gordon, where you have a growth recession, John, and you also have a Bramo recession, and that is a different recession.
The Bramo one, if you get that, you do not want to be in energy. I'm not sure, Bramo, you want to be anywhere invested in this market.
You just hide under the blanket. Is that what you're saying? That if I had my way, everyone would just basically be under their covers hiding? Look, no, I don't want to paint that picture. I hope that this is actually going to be a shallow recession. What struck me from the news conference yesterday was the lack of control that Jay Powell seemed to have and feel like he had over inflation, the lack of control and foresight considering the events that we saw over in Europe as well as in China. That's going to be the determining factor.
I can't wait to get excited about you, Mitch, every 2 weeks now. Is that the data point of the moment now? University of Michigan sentiment
according
to get the inflation expectations.
Inflation expectations, not the headline number, which Jay Powell said could be skewed to the bearish.
If that's the number we got to watch, I guess that's the number the Fed responds to, then it's important to us all. Futures down by 2.4%. Yields higher by 15 basis points, 342.92. We'll do extended programming for you, Mitch, next week when I'm not here.
Ann Arbor Decides. I love the show. Ann Arbor Decides.
You like that, Tom? That
I like
works.
that. Ann Arbor Decides.
I like that. This is Bloomberg.
Oh, we're blue.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The leaders of Germany, France and Italy are in Kyiv today for talks with President Volodymyr Zelensky, Olaf Scholz, Emmanuel Macron and Mario Draghi traveled together by overnight train in a show of solidarity for Zelensky and his government. The trip comes ahead of an expected recommendation Friday from the European Commission that Ukraine be granted candidate status to join the EU. Russia and China are giving differing accounts of President Xi Jinping's birthday call with Vladimir Putin. The Kremlin says the two men discussed economic cooperation, trade and military ties. China says Xi called for peace and economic stability and made no mention of military ties or increasing trade. The two men declared a, quote, no-limits friendship in February, weeks before Russia invaded Ukraine. European gas prices are soaring as Moscow tightens its squeeze on crucial gas flows to the continent. Germany has called the reductions through the Nord Stream pipeline politically motivated. Challenging Gazprom's claim that the halt was due to technical issues. For months, Europe has feared supply cuts in retaliation for sanctions aimed at Moscow for its invasion of Ukraine. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Feeling that comes from knowing you're inspiring your customers, uniting your team, recognizing achievements, and expressing heartfelt thank yous with promotional products people use and love from the experts at 4imprint. Your partners in creating special moments and memories by making people smile. Enjoy that feeling of certainty with promotional products at 4imprint.com. 4imprint, for certain.
At Lovesac, we design furniture for life. Real life. Messy life. Life that changes and brings us together for movie night. A life where batteries run down and get charged up again. Because now, Lovesac Sactionals can be upgraded with Stealth Tech and immersive surround sound by Harman Kardon hidden inside. Upgradable, washable, and guaranteed for life. Don't just hear it, feel it at a Lovesac showroom near you.
I'm always shopping The RealReal. They drop over 10,000 new arrivals every day.
From luxury brands I'm obsessed with.
Gucci, Rolex,
Prada,
Louis Vuitton,
Hermes, Cartier, Tiffany. All up to 90% off retail.
and I love that it's been authenticated. No one else can say all that.
Because no one else does it like The RealReal.
Thousands of new arrivals daily. Up to 90% off retail. Endless luxury. The RealReal. Shop now and get 20% off at therealreal.com. Terms apply.
Reduce carbon emissions, they say. When it comes to our planet, we need to do more. We choose positivity. We choose to change. Tomorrow now. We'll learn, we'll try, we'll do and undo whatever it takes to get there. We don't have to commit, we choose to. We choose Earth. It's up to us, and that's our biggest power, the power to choose. Do you?
What's happening on Wall Street?
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
this is a very soft landing kind of forecast. The Fed keeps talking about neutral being 2.4%, but 2.4% neutral is only if inflation's at 2%. If inflation's higher, then neutral's higher. And so I think the forecast, is still remarkably optimistic.
That was Bill Dudley, the former New York Fed president and Bloomberg economics senior advisor, making that point following the news conference with Chairman Powell just yesterday. This morning, we give back what we got from yesterday. Equities down by 2.4% on the S&P, the Nasdaq down by 2.8%, yields higher by 15 or 16 basis points. We've seen this a few times with the Fed now. Big rally on the day on a Chairman Powell news conference, then we fade it in the days afterwards and fade it hard. This headline, Tom, just across the terminal that I think will interest you and others too. Eni, the Italian energy company, says Gazprom Eni is only providing 65% of requested gas today. This is going to become a problem, Tom, if it continues into winter.
It is, and the spike up here, I looked at it briefly today. What is it, Netherlands TTF, John? Is
seen as the benchmark, sure, Tom, yeah.
Yeah, and the answer is it's not as grim as February 24, 25, 26, but it's getting there rapidly. I mean, it's like, it's June, it's warm. In 90 days, 100 days, it's not, is it?
And rates are going up, potentially at the ECB soon. A few times, Tom, inflation's too high. People are getting squeezed by this.
I'm going to get one question in here with Callum Pickering on Britain before John picks up with his expertise. He's senior economist at Berenberg. Callum, the big difference to me is the wage spiral of the United Kingdom. Does Governor Bailey have a true wage spiral that Chairman Powell does not?
It's a good question. The risks certainly point that way. Labour markets in the UK are tight. There's a job opening for every unemployed worker. The private sector seems to be paying out pretty handsome bonuses in order to incentivize hires and then keep hires. And so the latest data, you're pushing 7-8% year over year. It's totally unsustainable for an economy like the UK. It sort of presumes you need 6% productivity growth year over year for the Bank of England to hit its 2% inflation target. It's inconceivable.
Callum, I want to talk about the currency off the back of this central bank decision in about 10 minutes' time. You've got a pretty original view on why we're down here. I've been asking a question whether an interest rate hike from the BOE today of, say, 50 basis points would damage this currency or not. Some people have got that view. Callum, you don't think this is about monetary policy. You think it's about something else.
I don't think it's about monetary policy. I don't think it's about economic fundamentals. Actually, the UK, for all you can say about it, it's perfectly average as an advanced economy looks. I think what we have is a big Boris factor. You saw sterling weaken considerably once the UK voted to leave the EU. That baked in some economic trouble. Most of it actually didn't unfold. But what we didn't see is as the economy outperformed expectations, sterling rise. We saw sterling move sideways due to Brexit uncertainty. That persisted even as Boris Johnson became Prime Minister. My hunch actually is that if the Conservatives were to replace him with pretty much anyone else, or indeed if the Conservatives were to lose to Labour in any election, then what you would see is sterling move because the Brexit risks would diminish and markets would actually consider that UK fundamentals and broader political risks are actually, well, boring, I have to say.
Callum, forgive me for asking what might sound like a stupid question, but why would they diminish, regardless of who is in control? Why would it change direction?
That's a good question. Now, Boris Johnson, unfortunately, is like a man straddling two horses that are running in opposite directions. Those two horses are the different parts of his party that want different economic policies. One wants a kind of free market, low tax, low regulation approach. The other wants more government spending, increased welfare state, and that can't be reconciled. So what Boris Johnson seems to do is push Brexit up the political agenda so that he can nominally unite his party, which are all apparently hardcore Brexiteers, which actually I doubt very much. And so once Boris Johnson is out of the way, what you will find is the party will have to decide which economic direction it wants to go. Once it does that, actually the device of using Brexit to try and unite the party is no longer necessary, and then you don't worry so much about an EU trade war. You wouldn't worry about potential consequences for Northern Ireland. You'd even be a bit less concerned about Scottish independence because that seems to be partly a function and legacy of Brexit.
Callum, if the Bank of England doesn't have a lot of control over the currency because it's ultimately a political question, and they don't have control over inflation because it has to do with Brexit and it has to do with the cost of energy and the global inflationary pressures, how do they decide how to act? How much do they raise rates? How do they use rates as a tool amid futility?
Well, the thing that the Bank of England needs to just try and emphasize, and it's very difficult in this environment, is that even though in real terms the economy seems to be quite weak, it's moving sideways, in nominal terms, actually things are quite strong. It's surprising just how much households seem to be, despite this low confidence, just holding their nose and spending aggressively. So you have this big nominal adjustment upwards in prices and wages. Interest rates need to follow that. The challenge the Bank of England has is, upon now realizing it made a policy mistake last year by overstimulating, much like the Fed and the ECB, the risks are baked into the cake. The hard choice is maybe not between some kind of recovery and a recession, but actually what type of recession we will get. And so what I see from the Bank of England, also with other central banks, is this preference actually to run the risk of the near-term recession. Because if you have that, you get rid of the inflation, you probably start on fairly good fundamentals, and you get the business cycle unfolding. If you don't fix the inflation now and it gets worse into next year, then the recession has to be even bigger in order to recalibrate and recondition inflation expectations. So you always choose the policy which includes the lowest output loss risk, and that seems to be hiking aggressively, even though the risks seem to be accumulating.
So, Callum, about 6 minutes here to go until that decision from the Bank of England. What are you hoping that they do?
I'm hoping that they go for 50 basis points and signal that they will remain aggressive until they see, with confidence, inflation start to roll over and inflation expectations to fall to a level that is more consistent with their inflation target in the long run, and say, unfortunately, we just don't have the tools that can eliminate economic pain as this process continues. But what we will do is, by bringing inflation expectations down and inflation down now, limit the potential pain that could come through unemployment later down the line, because we'll avoid that more dangerous scenario.
Hey, Callum, thank you. Callum Pickering there of Berenberg with some interesting perspective on what he thinks is driving sterling right now. Andrew Sentence, formerly of the MPC at the Bank of England, put this out this morning. He said the MPC hasn't raised rates by more than 0.25% in its 25-year history. A 0.5% rise today would be the biggest rate rise since 1989. That would be a clear signal of how seriously the Bank of England regards the inflation outlook. Anything less, Tom, in his words, would signal a very weak policy response. That's just one view from someone who was pretty hawkish on the MPC back in his days on the Bank of England.
We're all addicted to vectors, getting online and being measured. I don't understand, John, why a given bank can't say 75 beeps and then we'll be wicked data dependent and see what happens. I think maybe that's what Chairman Powell was alluding to.
TK, they're stuck in the last 10 years. They're just trying to get out of this slow forward guidance mode of 10 years ago. Look at the ECB. That worked out. Look at the ECB.
Forward guidance was dead, John, the day it came out. I mean, it was
so?
It's comical.
Well, I think it's effective, Tom, if you want to try and commit to lower rates in the future, but that works when you've got inflation you think is too low, Lisa. It does not work when inflation is too high. That slowly movement from the ECB, the S&B's out there, the Fed's already gone, the Bank of England's set to go again.
John, we need team coverage in London. I think that's what we need to pick it up. Yeah.
Lisa, you signing off on any of this?
I have a lot to say, but we've got 5 seconds.
This is Bloomberg.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, But many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
A big change from the Fed.
The Fed definitely caught up with the market pricing of rate hikes for the next couple of years.
I think the Fed's forecasts are still remarkably optimistic.
Fed rate hikes just take a really long time to impact the economy.
All these numbers they threw out are fantasy land. The unemployment rate's fantasy land. The rate at which inflation is going to come down is fantasy land.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Oh, we have got a split at the Bank of England from New York City this morning. Good morning for our audience worldwide on TV and radio. This is Bloomberg Surveillance with Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. TK, it's 25. It's a 25 basis point hike, but that committee is split.
There is the fractious BOE. It is so different from the Fed, John. Esther George, one lone dissent. And this is, am I right, John? 6-3 is sort of an argument.
6 wanted 25. They got it. 3 wanted 50. The Bank of England says it will act forcefully on inflation if necessary. I'm not sure many people would characterize a 25 basis point move, Tom, as forceful this morning.
I look at the statement, John, no statement here on England and Hungary either.18
sure he's going to avoid that one today, Tom.
Thank you.
And we can avoid that too. Lisa, sterling, negative 0.9%. Cable, 120.78.
If the Bank of England was worried about where sterling was, it doesn't show in their decision today, because it seemed like, yes, they're trying to recognize the weakening in the economy and the negative print that they saw for a second straight month. But this weakness has got to get their attention in the sterling.
I think we've got to get across to Guy Johnson in the City of London. Guy Johnson, 25, is not getting it done for some people.
No, when you've seen what the SNB has done, when you've seen what the Fed did last night, 75-25 feels like a fairly weak response. But each central bank is dealing with a different set of forces. There are commonalities, there are similarities, but each is dealing with a different set of things that they have to factor in. The language has clearly tightened up, John, so we are going to act forcefully on inflation if necessary. The Bank of England doesn't have a history of going 50. Last time, I had a little aside with the governor after I spoke to him after the last meeting. He was surprised that the market hadn't taken the vote count as signaling a more hawkish intent. We get the same vote count this time round. Maybe they're trying to use it once again to signal that hawkish intent going forward. This is a weaker hike than anticipated by some. It's the hike that a lot of people did, though, anticipate, and it comes with a tinge of more hawkishness, I would argue, added to the statement. You're seeing a little dip At the front end, we've gone sort of circa 2%, just north of 2% on a UK 2-year, back to 199, 198. So a little bit of movement in terms of prices coming off for the UK 2-year. But to be honest, Tom, this is right in the middle of the distribution of outcomes. 25 with a slightly more hawkish tone.
I love the idea here that forward guidance goes. There's an official headline on forward guidance, but I amended it, Guy, to say to act as needed is the new forward guidance. How do you translate that?
We don't know, Tom, is the honest answer. I think they are looking at the data. They're going to act as needed. They will see how the data comes in. They are having to factor in a whole range of other situations here in the UK as well. The fiscal situation has improved for the consumer. The government has added some extra impetus on the fiscal side. That changes the narrative a little bit. The labour market is currently tracking pretty much as anticipated. Wage growth is tracking pretty much as anticipated, but growth isn't. So you're seeing this growth slow down. How those two balance out remains to be seen. Bloomberg Economics currently has the Bank of England tracking with a series of 25 basis point hikes up to around circa 2%. That's where they see neutral is, Tom. I think they're taking this meeting by meeting by meeting. There is no forward guidance. We'll do what's necessary. We will act forcefully on inflation if necessary.
125, I think it's necessary. Inflation, they say, peaking at 11%. The peak of inflation for the Bank of England, Lisa, won't come until October. That's the Bank of England's view on things right now. When you look at the perspective of the three hawks that voted for this 50 basis point move, and Catherine Mann is one of them again, they see the risk of a more resilient UK demand supply shortfall. Now, Lisa, this is part of the debate that we're having here stateside on the Federal Reserve. What will the Fed need to do? How high will rates need to go to tame demand and get inflation down? And that's the exact same conversation that's taking place on the MPC at the Bank of England.
Yeah, although the Bank of England seems to be taking the opposite approach that the United States does in terms of prioritizing the weaknesses they're seeing in the economy rather than concerns about persistent demand. Guy, if we take a look at sterling right now at 120.76, is this an indictment of the move from the Bank of England, or is it a support of it?
I think it probably is consistent with the idea that maybe some people had priced 50 basis points. It's interesting that the money market, the headline crossing now, is now pricing in 50 basis points for August. The Bank of England has never done 50 basis points. It doesn't do 50 basis points. It is incremental. It does 25 basis points. That's what we're getting at the moment. It is a much more cautious approach. Lisa, I would say there was some risk after 75 from the Fed, from 50, from the SNB, that maybe the Bank of England will be slightly more hawkish. That hasn't happened. Sterling has priced that out. Sterling trades on such a range of factors. I was listening to your conversation just a moment ago with Callum Pickering. There is a whole range of political and fiscal factors that also are being priced into sterling. Sterling is much more muddled. I think if you take a look at the UK 2-year, you're seeing a much more measured response. Sterling is all over the place. Sterling's got a lot to think about. The UK 2-year just moving a little bit. I think this is basically where the bond market saw things going. There is the possibility of 50 further down the road if inflation continues to accelerate to the upside. That's where I would look for my clues. Sterling's so bouncy at the moment, and it's got to factor in the dollar as well and what is happening with the euro.
I'm with you, Guy. Good to catch up, buddy. As always, looking at these forecasts, Lisa, just to re-emphasize them, they see inflation peaking slightly above 11% in October. GDP in the second quarter expected to fall 0.3%. They had forecast just 0.1% growth. But they say there's some upside risk here off the back of a government package, a cost of living package to boost growth and CPI. But Lisa, you put it all together, you've got the prospect of inflation peaking at 11% or above. You've got growth, which is really, really tame right now, put together with 125 on interest rates. I'm not sure anyone knows how to calibrate policy in this world.
Do you think that this is a belief in the Bank of England in transitory, that there will be a natural rolling over that won't come from their dampening demand with a higher and tighter monetary policy? That's going to ultimately become a question. How does inflation roll over if it's not coming from the monetary policy transmission mechanism?
Let's get to Jeremy Stretch on that, the head of G10 FX strategy at CIBC. Jeremy, just first of all, your thoughts on this Bank of England decision from 7 minutes ago?
Well, it's very much as I expected. I did think that the bank would maintain that incremental standard. As you quite rightly said, the MPC have never looked at a 50 basis point move, and to consider going into a historical precedent in a month where there weren't updated macro forecasts included in a quarterly inflation report, I think was always somewhat ambitious. Now, clearly the external factors in terms of other central banks had amplified market risk that the Bank of England could be a little more forceful. But ultimately, it is still very much a graduated response. And I've just been listening to your debate regarding the impact of inflation versus the growth dynamics. And clearly, I think the Bank of England are very mindful that the growth story is going to prove to be increasingly challenging. And I think that is how we would view it from CIBC. And I think that will certainly temper the reaction function of the Bank of England compared to what the market is anticipating.
Jeremy, tell us the political calculus between the Chancellor of the Exchequer and the Prime Minister with the Governor of the Bank of England as compared to President Biden, Secretary Yellen, and their pressures on Jerome Powell.
Well, clearly, I think from the Bank of England perspective, they cannot influence the fiscal dynamics, but clearly there has been a lot of political pressure on the Prime Minister in order to try and alleviate this cost of living crisis. So we have seen one set of measures at the end of last month, which were worth around 15 billion sterling. So that has provided a little bit of a fiscal impulse. I guess the question is, will the government consider the need for additional policy stimulus before the summer parliamentary recess in July? Because if that is the case, then I think that will amplify the case for 50 basis points come the August MPC. So there is really a sort of an influence in terms of how the fiscal backdrop plays out as to whether the bank will consider it appropriate to hike by 50 basis points. If the government do not put in additional fiscal stimulus between now and the August MPC, then I think it's still most likely that the Bank of England will be looking at 25 rather than 50 basis points at that next meeting. And I think the market, once again, may be rather disappointed.
Jeremy Stretcher, CIBC. Jeremy, thank you. Sterling down at 1%, as Guy pointed out. Sterling in the FX market, so much to think about this morning. Cable, Lisa, 120.60.
I think about what Callum Pickering said of Berenberg just moments ago when he said that perhaps the better option is to, I don't want to say force a recession, but really err on the side of going harder now and allowing that recession to happen sooner, which will actually take away the length of that recession. And I think that ultimately that will be the question that we start asking. How long is the recession that you're expecting? How long will it be if the Fed or the ECB or the Bank of England acts now versus how long will it be if they wait and they act with more tepid steps?
It's not the perfect parallel compared to what's happening with the Federal Reserve and the US economy, but there are slight things, Tom, that rhyme, a couple of them. And here's one. It's the labour market, and it's what the Bank of England is saying about it. A tight jobs market, firms pricing, of fueling inflation. And on the labour market, Tom, they said this, no signs of imminent labour market deterioration at the moment. And as we've talked about with regards to the Federal Reserve, how do you tame demand if we don't see unemployment go higher? And that's the uncomfortable part of this for all central bankers.
I just looked at trade-weighted sterling back 30 years. And basically, if they depreciate sterling by 5%, it goes out to new record weakness. And the chart looks like a banana republic. I mean, is basically the UK prosecuting policy understanding permanent sterling depreciation?
There are some people who are, and I stress some people who are worried about an EM-type dilemma for this central bank.
The chart looks like an
in
EM
the UK and for that currency.
dilemma.
Yeah,
I'm
with you.
I'm
You're
just
not alone
looking
thinking
at the
that.
Bloomberg.
You're not alone thinking that.
Okay.
Futures on the S&P are down more than 2%.
I think it deserves a trip to London.
Do you want to re-emphasize that?
I think the three of us. I think October 1,
why don't you just
Arsenal
speak directly
Derby.
to management, Tom, this morning and just
I think he is.
ask for that. I think he is too.
I think that's what we're hearing right now.
Bramo, I'll ask again, are you signing off on this? Is this a trip that we can make, or how do you feel
I think that
about this?
I feel like it will be something that will be affordable considering the exchange rate.
There we go.
Very well said. Lisa is the sharpest of us all.
Particularly if we avoid a Bramo recession.
120.70 on sterling, down 0.9%. We've had a 50 basis point hike today from the S&P, 25 from the Bank of England, 75 from the Fed yesterday, and more still to come. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The leaders of Germany, France and Italy are in Kyiv today for talks with President Volodymyr Zelensky, Olaf Scholz, Emmanuel Macron, and Mario Draghi traveled together by overnight train in a show of solidarity for Zelensky and his government. The trip comes ahead of an expected recommendation Friday from the European Commission that Ukraine be granted candidate status to join the EU. And some NATO members are looking to Germany for cues about how to boost the alliance's defenses against Russia. Bloomberg has learned the allies are considering adapting a new German model in their long-term defense planning. Germany's been identifying units that can be deployed to Lithuania at short notice and placing key equipment ahead of time. It's an alternative to basing new troops more permanently in the most vulnerable member states. The Swiss National Bank unexpectedly increased interest rates for the first time since 2007, shifting away from a battle to tame a stronger currency to focus on inflation. It raised its policy rate by 50 basis points. That is a dramatic move that sent the franc surging against the euro as Swiss policymakers joined the global bandwagon of monetary tightening. They lifted their inflation forecasts and said more rate increases may be needed. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
They dropped a critical sentence indicating they're not certain they can do this soft landing. That's an indication that they think they're running the risk of a recession.
That landing strip for a soft landing just gets a whole lot narrower over the last few months. That was Jeff Lacker, the former Richmond Fed president from New York City this morning. Good morning. Here's the price action. We're down more than 2% on the S&P 500. On the NASDAQ, we're down by 2.6. We take away yesterday's rally pretty quickly. In the bond market, yields higher by 17 basis points, back through 4% in Italy. 180 on a 10-year bond. On a 10-year treasury, up 17 basis points to 345.43. And I want to think about where we've been. The recent high on a 10-year, Tom, that high in the last week or so, 349.65. 349.65 just a couple of days ago.
Yeah, I'm locked on two-year yield, 3.35%, John, for the two-year to break out higher to a 3.43% would be a big deal.
It's a big deal, Tom. We had 75 from the Federal Reserve yesterday. We've had 50 from the Swiss National Bank, 25 basis points from the Bank of England and the ECB.
Yeah.
Tumbleweed.
Euro Swissy a 102 to go under a parity would be something. We're not there yet. There's a lot of things moving, a lot of movable parts here, including watching what happens in Japan. Right now, a gentleman from the Republican persuasion and from Arkansas, French Hill, joins us on this odd economy. French Hill, I believe in Arkansas you have a 3.2% inflation rate. You are the kings of chicken. Chicken is in ascendant in this nation because of the price of beef, etc. Can things get any better for Arkansas?
Well, Arkansas consumers, Tom, good morning, are really hurting from high gas prices. We're a rural state, and when I was in private business before I came to Congress, I had many employees in my company that drove almost an hour every day to work, and so gas prices are really hurting our families. They woke up Monday morning in Little Rock to crossing the $5 mark on gas. And so inflation is the top thing I hear about when I'm talking both to small businesses and families. And the second thing, and this is the irony in the economy, you're 100% right. The second thing that's brought up is quality workforce, trying to fill these open jobs in business.
Well, do you fill them by raising wages? I mean, what is the prescription? It's the oddest thing, folks, all this day-to-day crisis we're reporting on, and yet the joy of a fully employed Arkansas, right? How do we solve this conundrum?
Well, first, I think Arkansas is spending a lot of time, and I've contributed in every way I can, both in my business career and now in Congress, to better workforce preparation, better skill training for those coming out of incarceration, those coming out of high school, those still in high school, to make sure they have a path to the pursuit of happiness that's not a college degree. So we've got to do more workforce preparation, and believe me, our state and our counties are doing that every day. Secondly, I think there's a real issue with getting people back to work, and you raise pay, and let me give you a quick example from Central Arkansas. Amazon has recently come into Little Rock with 1.3 million square feet purchased, opening up their major logistics operations, and they're offering about $18 as a starting wage there. So that is also really disrupting that full-time 40-hour-a-week person that's at a starting career. So you're seeing rising wages at the bottom in Central Arkansas.
Congressman, how crucial is it to increase immigration to the United States and open up some of the pathways for people to come in at a time where you're talking about such a labor shortage?
Yeah, Lisa, it's such an important question, and it's been something where America has been stuck for a number of years of trying to do that in a smarter way. by doing more merit-based immigration policy, as well as clearing the decks on people who've been waiting 10 years or so with a professional degree waiting for a permanent residency status. So we let about 1 million people in legally in this country every year. It's something that we ought to always look at rebalancing that on the legal admissions. I would think more merit-based admissions would be good to get our markets more in line with the talent that we need.
Yeah, Congressman, how difficult is that for some of your fellow Republican Congress members to swallow, considering the fact that for so long there was a discussion about reducing immigration or limiting much more substantially? I mean, how much are you representative of the mainstream of the Republican Party versus an outlier?
Right. Well, thanks for that question, because it all centers on the fact that just as we're seeing every day here, record numbers of people crossing the southwest border illegally. And so for years, Lisa, the idea was if we can achieve border security, border control, or as our Secretary of Homeland put it the other day, operational control, which they don't have, that would open up the day, I think, to modify a lot of our internal immigration policies, and that's what we need to do.
French Hill, out of Vanderbilt years ago, I know you still have your Jerry Ford whip inflation now button. You know, as a smart banker guy, that you can't fix inflation. Joe Biden can't fix inflation. Even Elizabeth Warren can't fix inflation. What do you need from Jerome Powell to fix inflation?
Well, Tom, I think he took a bold move yesterday, putting the Fed on record that inflation is their enemy number one right now, considering we have such a surplus of job openings. We have a very strong labor market. So the 75 basis point move I thought was a bold one. He knows he's behind. Tom, you and I have lived through this for many decades. He knows he's behind. He wants to send the signal that the Fed's committed to not letting inflation expectations get entrenched in corporations and pricing. And in the meantime, I think clearly we have to do everything we can to get the supply chain open by unleashing America's power to get people back to work, supply chains open. And this is, as you say, not an easy task. That's why they call it the anguish of central banking.
Tremendously difficult right now. Congressman, always fantastic to hear from you. French Hill there with the latest in D.C. and beyond, Tom, and a focus on this Federal Reserve to do something about inflation expectations. And to the Congressman's point, that's the focus of this Fed. That's what seemed to have spooked them on Friday and Monday too.
Yeah, and John, you look at the Bloomberg this morning, and with the cacophony of central bank news that we have and how it folds back to the markets, I'm looking at the screen, John, and I'm wondering you get to your property at 9 a.m. or even to the real yield tomorrow, which foreign exchange pair is going to give way?
And which central bank has to make the next move, Tom?
The feeling right now.
I'm calling the BOJ right now, Lisa, Operation Ostrich, sort of with their head in the sand, pretending nothing's going on around them, but a lot's going on around them. That meeting could be interesting.
Especially because right now their hand is being called by a lot of traders. Part of the problem is diagnosing the problem, and Drew Mattis of MetLife wrote in and said that bringing down inflation via monetary policy is going to really charge a massive cost, and that a large portion comes from a lack of supply, not the strong demand. This is the debate. Is it more demand-driven or supply-driven or both? And how do you get monetary policy right if you don't have the correct diagnosis there?
You just got someone write in, Bloomberg subscriber Tom. I'm going to read it out. How has no one mentioned Tom's Kentucky Fried Chicken Colonel Sanders suit as he talks about chicken?
That's why I wore it.
So, that's gold. That's good.
That's gold. That's gold, isn't it?
Beige, actually.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Live from New York City this morning. Good morning. Here's the price action. Yesterday's rally, we take it back. We're down 2% on the S&P 500. On the NASDAQ 100, down by 2.6%. After the Federal Reserve projects higher unemployment, higher inflation, and much higher interest rates too. And some people believe they've got to go a whole lot further. Let's see how the equity market and the bond market looks somewhat similar, with yields higher, taking back yesterday's move. It's yesterday in reverse. We're up by 15 basis points on a 10-year, 343. 2 days ago, came this close to 350. We're not far off it now, are we? 343 again. Yields building up higher at the front end too by 15 basis points to 334. So we've had a 75 basis point move from the Federal Reserve, a 50 basis point move from the Swiss National Bank, 25 from the Bank of England, and nothing from the ECB. Take a look at Italy. Back through 4% this morning, briefly, then back down again, just a little bit, 391. Yields higher now by just 9 basis points, Tom, because the ECB has a plan to make a plan that could be approved by the Governing Council.
They got a plan, but I think this is, again, important. I said this earlier. I'm going to say it one more time quickly. Spreads matter. But what also matters is simple level of Germany, level of Italy, level of Finland, Hungary, the rest of it, and all. And John, I think it bears careful study here. The dynamics, what I see on the screen, I identify one word: flighty. Everything looks flighty right now. Everything looks tentative.
If you want to talk about levels, Tom, 180 on bunds, 350 on 10s on treasuries, 4% in Italy, levels we haven't seen for a long time.
Negative's over, right?
I think it's fair to say negative's over in most places. Though, Lisa, I think we have to say and point out, we're still at negative 50 on an ECB deposit rate. We're still at negative interest rates at the Swiss National Bank. There's still some work to do here.
There's work to do, but a lot of it's being done in the market because people are getting ahead of the expectation for going to neutral or beyond. And what we're seeing, if you want to know the negative yielding debt total, it's $1.6 trillion, down from as high as $18.4 trillion. It is evaporating. Eyes purely on the Bank of Japan.
And Europe moving too. Japan's next. The BOJ?
They got to move.
Really? What do you expect from them?
I mean, not this time, but they have to eventually move away from this because they're buying record amounts of JGBs. They don't have a market anymore. The yen's going the other way, and people are betting against them, and you can see that in the peg. I don't know. That's just my speculation.
Are we calling it a market in Japan still?
No, we're not calling it a market.
We're not, are we? I'm happy we've cleaned that up. Thank you.
I'm done.
That's the cross-asset price action. That's Bramo's rant done too. Let's get some single names and movers. We can do that with Romain. Good morning, Romain.
Hey, good morning, guys. Yeah, truly a global story. There's what the Fed says, there's what the economic data says, but more importantly, there's what people say here on the ground. When you look at the pre-market action here in the U.S., the 100 biggest volume movers out there right now, all but 2 of them are in the red. A huge reversal, of course, coming off of yesterday's rally. A rally, of course, that really started to wobble as we got closer to the close, as people, I guess, realized that this is isn't just about rates in and of itself. It's really about those shaky economic conditions that the CEOs of all these companies have been warning us about now for several weeks. Apple shares down about 2.6% this morning. Pretty much everything in the tech space is lower, as is everything in the retail space. Macy's lower by about 4%. These CEOs have been telling us consumer spending habits are shifting. Just yesterday, we heard from the CFO of Ford. He was speaking at a conference. It got overshadowed by the Fed meeting, but he talked about the idea of that new electric Mach-E vehicle, a really popular vehicle. It has basically been rendered unprofitable because of rising commodity costs. So they're feeling the pinch here. Those shares down to almost 3% here on the day. And then we heard from Elon Musk, and Tesla also is basically saying that they're having to boost the price of their vehicles for the third time so far this year. This is a big issue that could potentially cut into demand, but more importantly, we now know exactly how much is starting to cut into margins. Tesla shares down 4%. Everything in the EV space also down, including Rivian Automotive. Jefferies actually downgrading the sector as a whole, basically saying that the macroeconomic conditions and the inflationary pressures have finally caught up with this space, particularly with some of the high valuations still on some of these names. And if Elon Musk didn't have enough on his plate a little bit later today, well, Tom, he's finally going to address Twitter employees, all hands on meeting a little bit later today. The shares of Twitter are higher, I guess, because people think maybe this is a sign that Elon is going to go through.
Where do we stand on this? I mean, the company still thinks $54, right?
Yeah, and you're $38.75, so that's a $16 spread, deal spread right now. That tells you all you need to know. The max deal spread that we had was 18, so right now the market is betting that this thing ain't getting through.
Romain Bostic, thank you so much. Right now, we want to launch it to Troy Gajewski's Chief Market Strategist at FS Investments, with a very clear knowledge of how at times hedge funds take a loss. Troy, right now, everyone is taking a loss. What have you learned about alternative and hedge fund investment performance given a legit, ample bear market?
Well, look, I think if you look at alternatives broadly, it's such a wide definition. And if you look at strategies like senior secured commercial real estate debt, having very strong years, global macro funds finally taking advantage of Fed tightening and obviously broader dislocation, more market neutral strategies performing well that can take advantage of volatility. But obviously, if you stayed too long in go-go growth and got a little carried away in VC and PE, you're feeling a tremendous amount of pain this year and giving back 2, in some cases 3 years of return. And you often see this, right? The hottest trade, whether it was the late 90s in tech, or whether it was energy and commodities from really 2004 through 2011, when those excessive periods of performance unwind, you can have tremendous givebacks of performance. But the good news is most alternatives are performing well in an environment that's very, very challenging for fixed income as well as equities, to say the least. And unfortunately, there's more than likely more pain to come in broader markets.
Troy, typically when these kind of things burst, if you do indeed believe it was a bubble bursting, it takes a long, long time to play out.
Yes.
Years and sometimes decades. Is that what you expect to see here? And in what parts of the market do you expect to see that?
Well, look, I think it's pretty bold to say we're in for another lost decade. Clearly we've had other galactic mean reversion periods between financial assets and the real economy. The 2000 to 2010 period would be the most notable. But we're certainly in for at least the last several years in broader asset classes after, 13 years of a historic bull market and a 40-year bond bull market. But clearly tech continues to be at the crosshairs. Anything, it still has relatively high PDEs. Fortunately, price to sales have come down dramatically and have really normalized at light speed. And that's one of the factors in this cycle is it's not just the magnitude of the moves, it's also the speed. But that's one area wherever you don't have very attractive cash flows, whether it's still based on, revenue growth as opposed to really hard cash flow growth, those places are going to be challenged for multiple years. And, the technicals just don't look very encouraging anytime soon. So, don't be a hero. Don't try to average down into oblivion in the sectors that continue to suffer.
Don't be a hero, but can we write the obituary on instruments that really were the products of negative interest rates? Some people would argue that fueled the Bitcoin rise that you believed in for a while and you were talking about, right? I mean, can we write the obituary now on that crypto asset?
Oh, no, look, I think Bitcoin still, right, over the medium to long term, it's one of the additional ways that you can now hedge government profligacy risk And in the short and intermediate term, obviously the Fed is tightening money supply. We already have negative M2 growth, despite the fact that the Fed has just recently moved aggressively and yet has yet to drain the balance sheet. But over the medium to long term, it's really hard to bet against government profligacy. So even though we're going through a violent bear market, a recalibration of price, over the medium to long term, we'd still expect it to benefit from those really multi-decade trends. But certainly, at least in the short term, it's hard to get excited about any asset that doesn't have tangible cash flow behind it. And you're much better off being in the senior part of the capital structure, particularly in senior secured commercial real estate debt or in strategies that can take advantage of volatility now, as opposed to being preyed upon by it.
Troy, good to hear from you. As always, buddy. Troy Gajewski there of FS Investments. Just getting this news from the ECB, from the team over in Frankfurt, Germany. I'll read you the first paragraph. Bond buying under any new anti-crisis tool from the ECB would probably involve selling other securities so purchases don't upset efforts to curb record inflation. This story, according to people familiar with the matter, countries that benefit from it would have to meet certain conditions to avoid concerns the ECB is financing governments outright. So that's going to be interesting to see what those details and conditions actually are. At the very bottom of the story, I think for market participants, it's a very important line. Reads as follows. Flexibility may also involve front-loading reinvestments, meaning the ECB could buy new bonds before older securities mature. Tom, that's the part of this mechanism, this effort, that I imagine is getting people's attention in the bond market as the Italian yields roll over. And now positive just 5 basis points. So the high of the day was 390.95 on an Italian 10-year, and right now we're at 386.
Jenna Randall and Alessandra Migliaccio, John, have written the oddest fixed income story I've ever seen. You read the first paragraph of this story, and it literally looks like foreign exchange sterilization, except I'm going to invent the phrase bond sterilization. That's how contrived this is. Not silly, that's not the right word, but this is an exceptionally odd story of this desperation to come up with a new mechanism.
I remember the securities markets program in the crisis, Tom, in the Eurozone debt crisis, and I believe that was sterilized too to begin with. So I remember going all the way back then. What's interesting about this, though, Tom, is they're trying to tighten financial conditions at the same time they're trying to contain what happens on the periphery. And to trying to do those two things simultaneously, Tom, that's what gets my attention. That's the real difficulty at the moment.
They've got a 17 billion euros, 18 billion dollar gross flow, 12 billion of which, let's call it 60–70%, is from the core countries. Let's call those the successful countries. They need to bail out the peripheral countries, particularly down, I believe, south. I'll let you decide how much I should insult the Italians right now, John. But the bottom line is they want it both ways. They want to buy and sell
I'm not sure what's
at the
going
same time.
He's upset in London, and now I'm in charge of how upset the Italians are.
Yeah, you know.
So take us out, John. Let's go.
TK, you own that.
Randall and Migliacci have done a great job on this. It's a tour de force of confusion.
Okay. Up 18 basis points on a 10-year.
It's an anti-crisis tool.
346.39.
I was talking
Equities
about my
down
suit.
by 2%. Your suit is an anti-crisis tool.
My suit is an anti-crisis tool.
You think that's scaring the Italian bond market
It
this
is.
morning? Scaring the bond bears. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The leaders of Germany, France and Italy are in Kyiv today for talks with President Volodymyr Zelensky. Olaf Scholz, Emmanuel Macron and Mario Draghi traveled together by overnight train in a show of solidarity for Zelensky and his government. The trip comes ahead of an expected recommendation Friday from the European Commission that Ukraine be granted candidate status to join the EU. Russia and China are giving differing accounts of President Xi Jinping's birthday call with Vladimir Putin. The Kremlin says the two men discussed economic cooperation, trade and military ties. China says Xi called for peace and economic stability and made no mention of military ties or increasing trade. The two men declared a, quote, no-limits friendship in February, weeks before Russia invaded Ukraine. European gas prices are soaring as Moscow tightens its squeeze on crucial gas flows to the continent. Germany has called the reduction through the Nord Stream pipeline politically motivated, challenging Gazprom's claim that the halt was due to technical issues. For months, Europe has feared supply cuts in retaliation for sanctions aimed at Moscow for its invasion of Ukraine. The Bank of England has raised interest rates for a fifth straight meeting. The 9-member Monetary Policy Committee voted 6-3 to increase the benchmark lending rate by 25 basis points to 1.25%. A minority of officials maintained their push for a move of double that size. Policymakers led by Governor Andrew Bailey hinted that they may join a growing global trend for larger hikes if inflation continues to soar. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
There's a chance that we are already in a recession. And so if we are in a recession or we're close to a recession and the Fed pushes on this more, and then we find that all of a sudden we have a decline in asset prices like stocks did in 87, then if the Fed reverses course, they're going to look like they're weak on inflation.
Scott Minerd there, highlighted a big problem. The Guggenheim CIO from New York City this morning. Good morning. Equities down 2.4% on the S&P 500. We look like this on the NASDAQ, down by almost 3, off by 2.9%. Yields higher by 20 basis points on a 10-year and getting closer and closer to 350, 348.13, Tom, on a 10-year Treasury this morning. Troy Gajewski followed up his interview with this email. Great to see you. Wish I had time to give a shout out to TK's triple leverage cash ETF. It's having a great year, Tom.
It is. You know, I really want to.
It's the only safe place right now, TK.
Well, we're doing a mid-year review. We're right now. We're carefully monitoring.
You might allocate
the
some
volatility.
of that cash.
No, I just there's a lot of pressure on that, but we may. It's been so successful. We may go to a 4-pull leverage, but we haven't gotten there yet. It's a June 30 decision. We're not there yet. Our decision right now, Kriti Gupta on the dollar. What do you have, Kriti?
Well, we're just going to talk about the trade-weighted dollar here, because as we talk about these interest rate differentials that are really boosting the dollar, strengthening the dollar, let's talk about the other currencies that are involved here. Remember, a lot of commodities, oil, food prices, wheat contracts, all priced in the dollar. So as you see the surge, really a reversal, almost a V shape, as shown in today's chart of the day, that you are starting to see from the decline in 2020 and arguably half of 2021. The big question is, what does this do to exports, as well as you have a weakening euro, a weakening yen, a weakening cable rate, I should also add. But also remember, you have some competition in Asia between the Chinese renminbi, the Korean won, the Japanese yen, in terms of just the amount of exports that can be offered to consuming nations like the United States. And of course, that purchasing power, as shown for our radio audience by the surging dollar, that's going to be a significant part of the equation. It's not just about the Fed, it's about trade as well.
It is. That's a great chart. And on radio, it's real simple. Up we go, and up a couple of years ago, but you really wonder at what gap up in dollar if we're to break out of DXY at 105, where things become disruptive internationally. There's so much news flow we've leapt forward from the Fed meeting yesterday, which we must remember was absolutely historic. I remember a conversation I had with David Malpass, now at the World Bank, and Alan Meltzer of Carnegie Mellon years ago in the uproar of the great financial crisis. Guess what? Yesterday afternoon was like that. To give us perspective here, and particularly to give us Chicago perspective, Anna Wong joins us. She is Bloomberg chief U.S. economist. Anna, I look at a glide path of inflation that's not a smooth curve. It's not all the rose-colored glasses that we heard from Chairman Powell. It is down from 8% to somewhere of 4 or 5. And then there's exceptionally heavy lifting to get inflation back under 3%. Do you model, and does your team model, that they can get back to 2%, or is 3% inflation the modern era's new 2% inflation?
Yeah, Tom, you know, economists look at this trade-off called the Phillips curve. This is the trade-off between unemployment rate and inflation. And we have been saying that that curve is very flat. So in order to get inflation down by 100 bips, let's say it's at 3, and you want it to go down to 2, the trade-off would be about, you will need about 3 percentage point increase in unemployment rates to achieve that. So it's very costly.
And it's very costly, and it comes at the expense of the economy. One thing that you talk about was that it was unlikely just a couple months ago that there would be a recession before the end of next year. Now Bloomberg Economics is modeling in a 75% chance of just that. How soon could that recession come? I mean, this is really something that people are talking about in tandem with what it would look like.
Yeah, so we got to that 75% probability last week. That is before the surge in U.S. Treasury 10-year yield, which is one of the variables that entered into the model. So now with Treasury yields, the 10-year rate surging by almost significantly since last Friday, I think the model would have said that if we were to run it now, a significantly higher percentage probability. And I personally think that the recession would be quite shallow and short, because we don't see the kind of terrible balance sheets going into recession, and usually a financial distress could amplify the downturn.
In the core equation of GDP, Anna Wong, is the next recession coming? And I think people understood yesterday. I really don't believe in it. There was a guy, Samuelson, years ago, Anna Wong, I believe he was at some East Coast school, who said there's like 9 recessions predicted. Anna, it's simple. We're going to have a buoyant domestic economy, and maybe international dynamics lead us to negative GDP. Should I be afeared of too many imports into America?
Well, you know, imports constitute such a small percentage of U.S. GDP. It's not even, you know, a key driver. Accounting-wise, yes, it would lead to a negative GDP. But in that case, I'm sure the NBER folks who are dating recessions won't classify import surge-induced negative GDP growth as a recession.
There you go.
Anna, thank you. Wonderful. Anna Wong there of Bloomberg Economics. And Tom, this kind of points to what we were talking about in the last 24 hours, that Atlanta Now GDP Now forecast, which is negative.
Well, I'm going to go back to this. There's characters of recession. In the 80s, we had a double recession right back together. 73, 74, John, was ugly. I mean, you know, that was a little bit that I remember of it. But, you know, John, I mean, they're all different. There's a growth recession. As I mentioned earlier, there's a Bremo recession.
We started the program this way, Lisa. You have to think about where the leverage is. And we're told continuously that it's not on household balance sheets. The corporations are stronger. If that's the case, what does this one look like if that's what we're getting?
And that's why Anna Wong and many others believe that it will be a shallow one if we get it, and the likelihood is that we will. I just want to point to something that Jay Powell was talking about yesterday about the war in Ukraine by Russia and how that was really one of the major factors in inflation coming in faster than expected. Look at what's going on with European gas prices right now.
I know.
Up 24% on this idea that perhaps Russia's going to cut off some of the supplies.
That's natural gas.
That's natural gas, correct. How much is this really the difference between how deep the recession will be and how soon it will happen?
We've seen this the last couple of days now. Gazprom seemed to be starting to cut back, Tom. Heard it from Annie a little bit earlier this morning, didn't we? Providing 65% of requested gas today. That's the Italian energy company.
When was the last time we quoted this? Granted, it's weaker today, but dollar ruble is strong Russian ruble with all that cash flow coming into Mr. Putin. I mean, it's been widely reported. Maria Tadeo with photos today of 3 Western leaders on a train to Ukraine, and we got a little bit going on, John. I think we've underreported this, but this war is still front and center.
The European economy is going to squeeze, Lisa, and continues to get squeezed. And the ECB hasn't even started to raise interest rates yet. Have you seen this move in the bond market this morning?
Yeah.
The German 10-year. German 10-year is absolutely flying. Got a 10-year now up 24 basis points, pushing 190.
And you're looking at some of the highest levels that we've seen going back to 2014, a game changer. And how does this factor into an economy that's getting squeezed for non-monetary policy reasons?
Perfect guest next. Andrew Sheets of Morgan Stanley. Looking forward to that. He joins us shortly. Futures on the S&P. We're down more than 2%. This is Bloomberg.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question.
Great question. Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts, great questions. However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Big change from the Fed.
The Fed definitely caught up with the market pricing of rate hikes for the next couple of years.
I think the Fed's forecasts are still remarkably optimistic.
Fed rate hikes just take a really long time to impact the economy.
All these numbers they threw out are fantasy land. The unemployment rate's fantasy land. The rate at which inflation is going to come down is fantasy land.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television. A moment in history for economics, finance, and investment, and we see it on the Bloomberg screen. John, so many central banks acting, and what I see massively on the screen, tick by tick, is uncertainty.
Yields are absolutely flying, Tom, and they're flying higher. Even as we talk about lower growth, maybe even recession, yields are heading in one direction. That's up. You've got bund yields higher. You've got the 10-year Treasury higher, pushing 350. You've had a hike of 75 basis points at the Fed, 50 at the Swiss National Bank, 25 at the Bank of England. And Tom, more still to come.
Yeah, more still to come. And John, what is so important, folks, is we're not even discussing stories of import that are just pushed off the radar by this central bank derby. That ECB story from Jenna Randall out an hour ago, John, was the single oddest, desperate bond story I've ever seen. ECB, Lagarde, in search of an anti-crisis tool.
And they've got a plan to make a plan, Tom. They want to somehow contain Italian bond yields at the same time as increasing interest rates and tightening financial conditions. It's going to be really hard for them. It's going to be really, really tough.
Lisa, you mentioned the shocks that are out there, including natural gas to the moon and essentially Tunisia with elements of the Jasmine Revolution. Tunisia shut down this morning.
And you had also that fire at that plant, the export facility from the United States that exported gas to Europe, which also caused a spike in natural gas. All of these highlighting the real worry in yesterday's meeting with Fed Chair Jay Powell, where he was talking about chasing gas prices, chasing oil prices, that even though this is not within their control, it is in the headline number, and headline number creates expectations, and they have to fight that.
And John, even in boom England, and I mean this with huge wage growth, as we heard from Caitlin Pickeram, Corporations are adjusting. Out moments ago, Kroger, the U.S. grocery store chain, raises their view from a 375 up to a 385. John, the oddity here of measuring our gloom against what's coming out of corporations' mouths is fascinating.
And compare it to how consumers feel, Tom. We talked about that a lot. Consumer sentiment is deeply, deeply negative. Gas prices are very, very high. And the price of everything in the last 12 months, the price of a lot of things, Tom, has gone up. Think about central bankers right now. They're looking at the labour market, and from their perspective, they see strong labour markets. Maybe not Europe, but the UK and the Federal Reserve, they're saying the same thing about that, which raises this question. How high do rates need to go to contain inflation? The elements of inflation that they can actually control. And Tom, that debate is wide open still. Bill Dudley thinks much higher. Others think we might already be there.
Yeah, I mean, and Dudley was extraordinary yesterday. I hope folks, you, particularly Global Wall Street, go back and watch the Bill Dudley interview in entirety. John, the data check, I don't know where to begin. I'm going to try Euro Fragile 103.94.
Start like this. Yesterday, upside down, in reverse. Equities shaping up as follows. We're down 2% on the S&P, on the Nasdaq 100, down by 2.3. Yields higher by 16 basis points. The recent high, very close to 350. We're close now, up 16 basis points to 344.85. And Europe, we have a problem. We have a problem in the FX market. Euro dollar 103 again, 103.91. We're negative there, 0.5%, Tom.
Sterling off Bank of England 121.36. We dive into it with Andrew Sheets. He's chief cross-asset strategist at Morgan Stanley, really coalescing in mathematically, statistically, as is Brown University math, of what the total, the whole view is. And the summary, Andrew, is simple. Morgan Stanley thinks like Joe Stiglitz, growth matters. Tell me why growth matters.
Yeah, thanks, Tom, and it's great to be here. So I think this is a backdrop where the Fed is shown that it's going to have to be very data dependent over data that it doesn't necessarily have a great deal of control over, because the actions that it's taking now, as you discussed earlier on your program, are not necessarily going to do anything about gasoline prices, airfares over the next month or 3 months that are driving these inflation surprises that Chair Powell mentioned. So you have a situation where I think the Fed is somewhat captive to the incoming inflation data that matters a lot. And then the growth outlook is also very uncertain. I think the Fed acknowledged that uncertainty. I think, we see it in our own forecasts where there's a lot of different data pointing to different trajectories for the economy. Where we come out of all of that is to try to be relatively defensive, to try to keep positioning light as you continue to have a number of cross currents going on here.
Andrew, it's amazing to me that we talk so much about the prospect of recession, and yet we've hardly talked about downgrading earnings. I had Binky Chadha at Deutsche Bank on yesterday. I think it was the first time I'd spoken to someone on Wall Street, an equity strategist who was actually cutting their earnings expectations. First time in a while. Andrew, I know that you and Mike Wilson have been on top of that story too. What do you make of that? That we haven't had the warnings from corporations, we haven't seen the street downgrade earnings in a way that would match this recession conversation.
Yeah, Jonathan, I think this is what's so fascinating about what's going on is I think that's exactly right in terms of the next thing to focus on. When we think about the market, and particularly the U.S. equity market, my colleague Mike Wilson thinks the market has generally adjusted to the rate rise that we've seen, roughly. What it has not adjusted to is earnings downgrades, which you usually get when you've had this sort of reduction in financial conditions, when you have had these sort of risks around growth, when you have the declines in PMIs that we think are likely. So I think that's now where the rubber meets the road. There is a scenario that's more positive than ours where the companies are able to continue to earn profits and hit those consensus numbers. And in that case, the market could stabilize around current levels. If they cut earnings as we expect, then we still think that there's some downside risk here and it's too early to try to enter the market.
Andrew, which is the reason why perhaps you're looking elsewhere. I was kind of surprised to see where else you're looking. Japan? Why? Based on the fact that you've seen that the yen depreciate so significantly, and a lot of people expect that they will eventually, the Bank of Japan will eventually have to follow its fellow developed market central banks.
Yeah, that's a fair question. So it's pretty apparent that every major global equity market in the world has its own particular challenges. We just discussed the U.S. Europe has active ECB hiking. It has the war in Ukraine. China has the challenge of a zero COVID policy. And Japan also has very easy central bank policy that's increasingly disconnected from the more hawkish policy elsewhere. But we think for the moment, that's one of the better challenges to have. We think the Japanese market is not priced for the yen depreciation that we've seen so far. We think that if the yen were to stay around 135 or move higher, move weaker, that would result in earnings upgrades at a time when other regions could be seeing earnings downgrades. Japan has derated significantly. It's not nearly as expensive versus history as some other markets are. And we do think that the Bank of Japan will stay patient a little while longer because the inflationary pressures in Japan not only aren't as severe right now, they've been so much lower for so much longer than the U.S.
So when you talk about creating some sort of ballast to the portfolio, I understand the bet on Japan to some degree. However, there's got to be some bigger pool of securities that have to come from a place like the United States or like Europe. If you don't like stocks right now because of that earnings uncertainty, how much conviction can you have around the long bond at a time when the Fed is going really aggressive?
Yeah, no, I think that's one of the challenges. I mean, I think this is an environment where overall exposures, gross exposures, investors should be trying to keep those lower and to stay more liquid, because as we've just seen over the last 24 hours, the price action can be extremely volatile. It can be extremely hard to manage those risks, and there's large amounts of uncertainty. So I think keeping lower exposures generally in this environment makes a lot of sense. I think it's trying to look for kind of relative value, putting more relative risk into relative value strategies than directional strategies at the moment, as I think we are seeing a number of instances where relative value is working despite the volatile environment. And then it would be something like oil, which is an asset that we like, where you have an inflation hedge that pays you quite well to hold it, given how backwardated that oil curve is. And so that's a way to generate some yield while also providing some protection.
Andrew, just to clarify, 3,400 is still the number for you guys on the S&P?
Yeah, that's where we think the risk reward starts to look more compelling.
Okay, Andrew Sheets there at Morgan Stanley. Some downside still to come then for the team over at Morgan Stanley. Andrew Sheets there, working closely with Mike Wilson, of course, at Morgan Stanley too. The equity market looks like this. We take back yesterday's rally. We're down about 1.9%. We take back a lot of it anyway on the NASDAQ 100. We're down by 2.24. Just sit on this move in the bond market a moment. We're up 16 basis points on a 10-year Treasury to, let's call it, 345. On a 10-year bond, we're up 19 basis points to, let's call it, 182. And in Japan, we're at 25 basis points and going nowhere. Tom, this bond market has sat out the whole sell-off worldwide in Japan because the Bank of Japan is just sitting on it, keeping it there. How sustainable is that policy going to be?
It's absolutely not. There's
as the world around them goes in the other direction.
John, whatever anybody thinks, no one thinks it's sustainable. At some point, that experiment, and frankly, cultural experiment, behavioral experiment will end. And how it ends, it's not my job to pontificate on that. I will say, John, this screen is original I'm looking at. I don't want to be gloomy. It doesn't harken back to 08 or 07, but it's amazingly flighty. And what I would watch right now, John, is euro dollar 103.94 with some key mid-May weakness to confront here with a move down.
And just a reminder, Lisa, the ECB still hasn't made a move either on interest rates.
Right, although their hand is being forced and they're coming out pretty aggressively with guidance.
Big time. Euro dollar 103.94. Coming up, Leslie Vinjer-Murray, the head of the US and Americas program at Chatham House. Looking forward to that. Equities down from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The House Committee investigating the January 6, 2021 insurrection of the U.S. Capitol will focus today on the pressure then-President Donald Trump put on Vice President Mike Pence to block congressional certification of Joe Biden's presidential election win. The panel will hear Trump was repeatedly warned his plans were illegal. The hearing may include testimony from Trump aides that when Trump learned rioters invading the Capitol were calling for Pence's lynching, he responded by saying Pence, quote, deserves it. Some NATO members are looking to Germany for cues about how to boost the alliance's defenses against Russia. Bloomberg has learned the Allies are considering adapting a new German model in their long-term defense planning. Germany has been identifying units that can be deployed to Lithuania at short notice and placing key equipment ahead of time. It's an alternative to basing new troops more permanently in the most vulnerable member states. U.S. authorities are sailing the $325 million super yacht they seized last week to Hawaii. The yacht is linked to Russian billionaire Suleiman Karimov. It's a big win as the U.S. looks to confiscate Russian assets and push oligarchs for their country's invasion of Ukraine. The 348-foot Amadea is now sailing under an American flag and manned by an all-new crew. South Korea will expand the role of nuclear energy in order to meet its climate target. President Yoon Suk-yeol's new government said today it will increase the portion of atomic power in the energy mix to meet its emissions reductions goal. The country will maintain the target set by the previous administration to cut emissions by 40% by 2030. Yoon, who took office on May 10th, touted nuclear energy throughout the campaign. Global News 24 hours a day. I'm Ritika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that
over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
This is, a big change from the Fed in going from, magical thinking in terms of their earlier projections to a little bit more realism. But the challenge really lies ahead.
That's a new one, magical thinking. Looking at the Fed's forecast, Jeff Rosenberg there of BlackRock, a portfolio manager from New York City this morning. Good morning with Tom Keene, Lisa Brammertz and Jonathan Ferro. Futures are down by almost 2% on the S&P, off the lows, but still negative 1.9%. On the Nasdaq 100, down by 2.25. Yields are much higher this morning, up 15 basis points on a 10-year, 343.69. It's not just the US, it's Germany too, where yields are higher by 18 basis points on a 10-year, Tom, in Germany, 181. Do you remember when it was negative about 2 minutes ago?
2 cups of coffee ago.
End of the year, I think, it was negative 17.
Yeah. Euro Swissy, Swiss National Bank makes a move. 103 becomes a 101 this morning. Stronger Swiss franc, I should say. This is a joy and well time. Leslie Vinjamuri joins us right now, head of U.S. and America's program at Chatham House. And Leslie, off our radar has been Ukraine. I mean, there's just been so much news flow in economics, finance, investment. I've underreported it. I've underread that. Odessa, through the Black Sea, past Istanbul, and down to Tunisia is 42% of the wheat that Tunisia brings in. And they're not doing that with Ukraine. And the price of wheat in Ukraine has gone from like a 250, 270 level up to a 400 level as well. The wheat and food ramifications of a Tunisia shutdown this morning, it's here and now, isn't it?
It absolutely is. And of course, many people have been forecasting this for a long time. But the political pressure, it comes from those who are actually supporting Ukraine in the West. The impact, some of the greatest impacts are coming from a very different part of the world, across Africa, across the Middle East. People who are relying on food that are suffering those rising food prices, but that mobilization isn't getting channeled through our governments that are making the decisions. So now I think we've been slow to respond. There are many people who are saying we've got to have some sort of effort to try and get the grain out of Ukraine and Russia, to create some sort of exception for that, to really ameliorate what could be very devastating political and economic impacts.
I saw a bar chart of U.S. cash commitment to Ukraine versus others of the allies. I was sort of thunderstruck at the size of the U.S. commitment. In the next 6 months, did the allies get their act together, not only about the war and ammunition, but also about the food crisis, which for Tunisia is here and now?
Well, I mean, there are a lot of things in that. I mean, the first thing is that there is concerted effort. The U.S. is always going to spend more, but there's a lot of division across Europe on this. I think you see the U.K. really strongly aligned with the United States. Germany is obviously a little bit more torn internally.
Even Scandinavia,
this is a big change.
Even
aligned, Scandinavia, those numbers are lower. But on the food question, there is a sort of, how do you get those grain exports, those commodities out of Russia and Ukraine? And that's got to be an international effort. That means probably working with Russia. That's a very complicated set of mechanisms that again, many people are working on. Very controversial, but incredibly important and grave risk. Not only for food insecurity, many people across the global south facing dire situation, but also, as we've seen, for the political impacts of that.
Leslie, you talk about the U.S. leading, and there has been some question about the U.S. leading with a president largely thought to be a one-term president, increasingly low popularity ratings, especially as the inflation rate surges, and the expectation is increasing for recession. Who leads the party forward? Who is going to be the main compass of leadership over the remaining 2 years and beyond in terms of the Democratic Party?
Well, this is a concern, but you could argue that a one-term president, if that's what President Biden faces, I think it's very far from certain. 2 years is a very long time in U.S. politics. A one-term president has the ability to take some brave and bold measures, probably not through Congress. But I think there's a lot to play for here, and as we know, we're watching the January 6 hearings. We're watching how Americans will respond to inflation. Whether they will attribute the price rises that they're feeling to the war in Ukraine, I think is a very big question, and I think there's a lot of division on that. Again, these are deeply political questions.
But Leslie, from a deeply political perspective, is it in the Democrats' best interest to really make a conclusion? You said that it's very unclear whether he's a one-term president. We're talking about popularity ratings that we have not seen for a long time in terms of how low they are, and inflation that is at a 40-year high. Do you think that there is a feasible path for him getting reelected? And if not, isn't it logical to try to get the other person up and running?
Again, I think that politics is a question of alternatives. A lot will depend on who the Republican Party put forward. If they take the House, if they take the Senate after the midterm elections, what measures do they take? How does the American public respond to a Democratic president who is impacted by a Republican Congress? That will change how people feel. But to your broader question, of course, President Biden needs to have a very strong team around him. He's continuing to build that, to bring new people into the administration. We're seeing some of those announcements recently. But I think that this is a president who's, is facing a very difficult domestic situation, coming out of COVID, coming out of an extended war that's gone on for many months, that's hitting and driving forward inflation, that's driving forward potentially an economic recession, not only here but across the world. So a U.S. polity that, as we know, is deeply polarized. A lot of that polarization is driven very actively by those who seek to sort of undermine this president and his agenda. So there's a lot, I think, to play for. Very difficult to predict what will turn out. But I think right now the key thing is responding to this war, responding to the problem of inflation, and responding to the multiple domestic concerns that are dominant domestically in the U.S. and doing it in partnership with Europe, but really trying to build on those global questions, build that partnership far beyond Europe. That's arguably one of the biggest challenges. How does this president work not only with America's traditional partners, but really to expand the international support for measures that will really turn the needle for so many who are facing very dire circumstances on a daily basis.
Leslie, thank you. Leslie Vinjamuri of Chatham House in New York, I'm pleased to say. Tom, at the start of the year, I think we both said that the calendar might be on the president's side, that things could get better as the year grew older. Yeah. I think that's changed over the last few months. There is a real feeling now that things get worse before they get better, particularly going into the midterms later this year.
124 and Brent crude down to 117 is where we are right now. And I would just suggest, John, that for the president, for domestic politics, it is just about a gallon of gas. That may be odd for our international audience to understand, but as you heard from French Hill, they drive in Arkansas.
The bills are headed in the wrong direction, Lisa, and wages aren't keeping up.
And that's ultimately going to be one of the main driving issues as people head to the polls.
Futures down 1.8% on the S&P 500. Your opening bell 1 hour and 4 minutes away.
We know that it's highly transmissible We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Equities down about 1.9% on the S&P, and the Nasdaq down by 2.2%. Waiting for some economic data in the United States of America. Jobless claims coming any moment now, which is Mike McKee. It means Mike McKee has ran from Washington, D.C. to New York to jump into the studio.
He's amazing.
It's just incredible, Tom. Lost for words. Morning, Mike.
Good morning, John. Well, we're back in that situation where every data point counts and bad news is bad news as we try to figure out whether the Fed does 25 or 50 or 75 at the next meetings. And we've got some numbers here that will be interesting to the Fed, but don't look like they're going to make a lot of difference. The jobless claims numbers come in surprisingly unchanged from last week. They're 229, initially reported as 229 last week. It's actually was 231, so you end up with a decline in jobless claims. The Fed is looking to see if that's a harbinger of, if claims are a harbinger of softness in the labor force. Apparently not yet. Housing starts and building permits, Jay Powell said yesterday, the Fed's rate increases are having an impact on housing, and boy, did they, down 14%, 14.4% last month, although the prior month was in April revised from a 0.2 decline to a 5.5% gain. So maybe we're about 9% difference. Building permits, though, fall 7% after a 3% decline. So building permits are falling. It does look like builders are starting to pull back, and we did see that in the builders survey yesterday. Finally, we've got the Philly Fed number out there. People watching these regional Feds to see how business is going around the country. Not so good in Philly, down 3.3.
Bundle of joy today.
Yeah, I'm a bundle of joy. Which is down from 2.6 the month before. So problem for the Fed in that the Philly Fed suggests manufacturing lightening up, housing starts certainly being affected, but still nothing in the jobless claims numbers. A lot of, as somebody put it today, anecdata that companies are starting to announce layoffs. But at this point, we're not seeing a lot more people who are looking for work and out of a job. Let me just quickly look here. Number of employees in the Philadelphia Fed survey goes up. So go figure.
There we go. The losses in equities stick, Mike, so not much change in there. We're down about 1.9%. Something does fade, though. It's the gain in the Treasury yield, up now by just 12 basis points to 340. Bramo, those housing starts, that's pretty ugly. You get the feeling that's the start of more to come here in that part of the economy.
This is one of the fastest moving markets I've ever seen in terms of a 6% mortgage rate. What does that do to demand when you look at the all-in costs and how unaffordable housing already is? How much do we revert back to bad news being good news for the markets, because it signals that you're getting that weakness that could potentially prompt the Fed to stop raising rates as much and as quickly as they seem to be forecasting? Housing market is a key one, especially given where mortgage rates are and especially given the run-up in prices that we've seen, John.
Try selling that one, Tom. At least I think that's such a hard sell for people. The Fed backing away because the economy is rolling over and inflation is going to persist.
Well, not necessarily backing away, but not raising rates as quickly as some people are projecting. And this is the reason why some people actually are still holding on to conviction with risk assets, because otherwise, what's the wager if the Fed's going to really go to 4% by the beginning of next year?
Yeah, that whole debate about September and the pause, Lisa, I'm with you. I hate the idea that bad news is good news. You've got to think about why the Fed would have to back away. If inflation's coming down more quickly because you get this massive supply side response, without a doubt, that's bullish this market. But if you've got to back away, Tom, because the economic data is dreadful and they're going to have to tolerate much higher inflation for longer, that's a problem.
Michael McKee with a rude question yesterday. Let's review that right now. Nominal versus real data. And the chairman sort of stumbled over your study of nominal versus the real economy, how the economist should go about this. Help me here. If we have tepid real GDP, but then you overlay on substantial inflation, that's a high animal spirit for the country. Is that factored into the analysis right now?
Well, it does, because the Fed is supposed to target headline, and headline numbers keep getting pushed up by things the Fed can't control. The Fed would like to look at the core rate of inflation,
but they can't.
And they, in terms of trying to figure out what policy they'll make, they do. But the problem then becomes, what do they say to the average person who's still filling up their tank and paying $80 a tank, and then their confidence level goes down and they stop spending money?
John, I thought once again McKee was ignored by Chairman Powell.
Oh, I thought you asked him a zinger. I thought it was such a good question.
It's a trend.
Mike, it was such a good question. What did you make of the answer? Just briefly, Mike. You asked him basically whether he'd keep chasing headline inflation, which ultimately was being fueled by what happened with crude, and I think you were pretty blunt about it. You're going to chase the oil market here.
Yeah, and he said, we don't want to, but we may have to, because that's what consumers respond to. And I think the whole overhang of the news conference was the Fed is thinking it's going to have a very tough time bringing down inflation, because so much of it they can't control. And that just that answer kind of fed into it.
You know Esther George better than anybody in the business. You've owned her for years with Jackson Hole coverage and all that. Were you shocked by her dissent?
We were all surprised. There was a question we were in the lockup of, I wonder if anybody dissented. And then it was like, of all people. But it probably came about because she didn't want to upset the forward guidance that they had put in place before the meeting. I don't think that she seriously thought there's not an inflation problem.
Mike, thank you. Mike McKee there. The other interesting question was the Wall Street Journal journalist, Tom, asking a question about whether he should have thrown in the towel on his guidance, when ultimately there was a feeling that the Wall Street Journal journalist was briefed on the matter.
I know. McKee's got a Graham Banks 48 that's called Fed Whisperer, so,
Looking forward to Jackson Hole, Tom, with Esther George at the end of August. That's going to be an interesting one.
Pioneer Grill, 10 a.m. for a full Wyoming.
You put the table, have you?
No, it's a counter.
Oh,
it's
right.
Ugly,
okay.
Yellow linoleum.
Nice, you're selling this one.
I know, you can hook your Tony Lama boots right around.
Lisa can't wait.
Bar, John. Right now, Thomas Purcelli joins us, Chief U.S. Economist at RBC Capital Markets. Tom, I want to go to your wheelhouse, which is wage dynamics. I look at ECI, I look at wages and benefits, and then I adjust it for Joe Biden's crushing inflation. It's a chart I've never seen. How bad is our adjusted inflation less wages?
Yeah, so so good morning, but can I first say that Mike McKee was brilliant yesterday. I loved all those questions. I think because this is something that we've been talking about for quite a while. This idea that, you know, chasing energy, the thing that you really have very limited ability to control, if any, is a really tricky thing. And I think that this idea that it's, you know, inflation expectations are rising because of it. Look, we're really sympathetic to that. This idea that, you know, on last Friday, I think that the 5 to 10 year Michigan inflation expectations number was more important than the CPI. But I think we need to get to a point where it's probably fair to ask at some point, what is driving inflation expectations higher? Now, yes, today, right now, you can make the case that it's pretty much everything, right? I mean, everything is rising. But I can easily see a scenario where we're getting to the point where it's really just food and energy that's doing all the driving there. And those are the things that the Fed has very limited ability, if any, to control. So I'm sympathetic to the rise in inflation expectations, but I think that it's something that the Fed, I wrote this yesterday, I think the Fed needs an exit ramp from this. Because if they're just going to hitch their wagon to energy prices, funds are going to be meaningfully higher, and we're going to push ourselves into, I think, probably a sharper slowing than we probably need to have. So sorry, just to say that. And then, Tom, to your question, look, I think it's, wages are going to slow down. They're already slowing down. That's not a guess. I mean, that's just what's happening. And I think if we're right that the labor backdrop continues to soften as the year progresses, I think that will sort of signal what the fate of wages is.
Tom, there's a school of thought, first of all, that the Fed got it so wrong with their transitory thought that they cannot continue to have faith-based policy with respect to how quickly the inflation will come down. But second of all, that if they induce some sort of slowdown now, it will be a shallower slowdown, a shallower recession than letting some of these inflation expectations build. Why do you disagree?
Yeah. I don't disagree. I mean, you know, one of our sort of central frameworks but over the last several weeks has been, you know, this could very well look like sort of a 94, 95 scenario, right? That sort of that classic mid-cycle slowdown where, you know, you had a couple of sectors in recession, you had some job losses, but things didn't get so bad that the NBER actually called it a recession. I mean, that had been sort of our working assumption for a while. And I think if the Fed can find this exit ramp, right, this off ramp, and not have to get too aggressive, I think a scenario like that could still play out, where you have you know, sort of a couple of sectors that are sort of slipping, consumer gets a little squishy, and you have some job losses. But I think again, if this is going to be a, you know, chasing energy story, then I don't know what the off ramp on that is. I mean, because I don't know how to no one knows how to forecast energy prices. I mean, let's just be clear on that. And so if you're just going to be chasing energy, then I think you're going to put us in a place where we don't necessarily need to go.
Tom Purcelli of RBC. Tom, great work as always, sir. That's the difficult part of this, and I think Mike McKee got to the heart of some of the problems here, Tom. Just how far, Tom, this Fed is going to push things.
This is an ancient conundrum. We're living in a nominal world. You can get a British phrase, money illusion, whatever you want to say, John. The fact is we're all living nominal and we're all living headline inflation. And in the Fed's defense, there's a lot of research to eliminate out selected things. And, you know, do you take out airfare? Let me know. I mean, you know, just is one oddity right now.
It's getting stickier. And it's got broader over the last few months, too.
I agree.
And clearly they were spooked by that expectations piece of you, Mitch.
Well, they
Lisa, that's fascinating to me.
Yeah, well, you've been saying it all morning. Do we have to now focus on the inflation expectations of the University of Michigan, and we have to have a special when that comes out? The key issue for me is that broader aspect. How much and how quickly do rents come down? How much does the cost of healthcare come down? How much do the other costs around services based on how much wages are going up come down? And that might determine the trajectory of what the Fed has to do.
What they can impact in a big way is the housing market. In a massive way. Housing starts down more than 14%. How much more of that are we going to see? Equity futures down 1.76% on the S&P. Kathy Jones is coming up from Charles Schwab, and Vishy Tripator. Looking forward to that a little bit later in the next hour on Bloomberg TV.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The leaders of Germany, France and Italy are in Kyiv today for talks with President Volodymyr Zelensky. Olaf Scholz, Emmanuel Macron and Mario Draghi traveled together by overnight train in a show of solidarity for Zelensky and his government. The trip comes ahead of an expected recommendation Friday from the European Commission that Ukraine be granted candidate status to join the EU. Russia and China are giving differing accounts of President Xi Jinping's birthday call with Vladimir Putin. The Kremlin says the two men discussed economic cooperation, trade and military ties. China says Xi called for peace and economic stability and made no mention of military ties or increasing trade. The two men declared a, quote, no-limits friendship in February, weeks before Russia invaded Ukraine. In the UK, the spotlight is back on Boris Johnson's conduct during the Partygate scandal following the resignation of his ethics advisor, Christopher Geitz, quit just a day after suggesting in Parliament that the Prime Minister had breached the ministerial code. Police fined Johnson for attending a gathering for his birthday in Downing Street in June 2020 in breach of the COVID lockdown rules his own government brought in. Monkeypox is spreading in Africa, including to countries where it has not previously been recorded. The World Health Organization is raising concerns after cases were found in at least 8 countries, but the agency says at this point it is not recommending mass vaccination. Next week, the WHO will hold an emergency meeting to assess whether the current spread of monkeypox constitutes a public health emergency. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
At the Delhi airport, and behind me you can see SpiceJet's 737 MAX aircraft. said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
The Fed definitely caught up with the market pricing of rate hikes for the next couple of years. So really, that was a little bit more than I had expected. I thought that they would be a little bit more gradual. But you know what? I think that they said they're going to move expeditiously, and they've kind of stuck to their word.
Sabrata Rajappa, SocGen, head of U.S. rate strategy, and thank you to all of our guests yesterday who made for a really spirited conversation, particularly the attendance of Scott Minerd and his comments. Lisa, we've barely mentioned Bitcoin. I mean, Minerd didn't mince words, 8,000.
Yeah, people not necessarily seeing a place to buy given the withdrawal of free money and real yields that actually are real and yielding.
21,000 on Bitcoin right now. Right now, let us look at what matters to America, and it's far more than the economics, finance, investment. It's the stock market that we do. It's about housing. Let us take 4 days across 4 Fed meetings of 2022 and look at the mortgage, the 30-year bank rate fixed mortgage, and the yield has gone up 3.73%, 4.47%, jumping up to 5.50%, and on the 6%, which Julian Coronado noted last week. Kelsey Barrow joins us now with JP Morgan as well. Link in the JP Morgan world of bonds, yield, price dynamics into real estate in the 30-year fixed mortgage.
Yeah, absolutely. So if you look at the Fed funds rate, it's risen 150 basis points, but the 30-year fixed mortgage rate has risen by double that, 300 basis points all the way to 6%. And we already are seeing the impact on the housing market from that move, and we will continue to see the housing market decline. But I think what's really important to note about this move in financial conditions is it's been so severe that in any other scenario, the Fed would have paused. The reason that they haven't paused this time, despite the fact that mortgage rates are up 300 basis points, is that the inflation environment is just not letting them. And I think what really spooked them last week on Friday is that University of Michigan sentiment
Powell mentioned
report.
that yesterday.
Yeah, absolutely. He mentioned the University of Michigan sentiment ticking up. Now, what we do know about the University of Michigan sentiment data and the University of Michigan inflation expectations is it's very correlated to gasoline prices. And some of that increase in gasoline prices is out of their control. So they're putting themselves in a very difficult situation, but one where they're clearly saying we're going to prioritize inflation over growth.
I mean, Lisa, one of the stories here is oil's only gone 124 to 118 on Brent. I mean, we barely had a pullback, Lisa, in oil.
And it isn't necessarily translating into a pullback at the pump because gas prices, refined goods, are not getting cheaper because of a lack of refineries. How does this really bleed into credit, Kelsey, has been a question that we talked about with a lot of investors yesterday. They were seeing the prospect of wider credit spreads, of more credit losses kind of being implied despite the fact that you don't see near-term maturities. Do you agree that it's the up-in-quality trade going to higher rated debt, or do you think that there's some value given the 8.5% yields and high yields?
Well, clearly financial conditions are tightening and the risk of recession is rising. But if you look at current default rates, obviously they're very low. They need to normalize somewhat. But corporate fundamentals are really strong, and companies have done a number of things to set them up for an environment where we're not particularly concerned about credit losses. They've done things like increase their cash, reduce their leverage, and also term out their debt. So if I look at the high yield market, for instance, less than 6% of the market is maturing in 2022 or 2023. So there's not that much sensitivity in the high yield market, which has become much more higher in quality than it has historically, to these higher rates. Now, I think that there's going to be volatility, and what we're focused on this summer is increasing the liquidity of our portfolios, because the one thing that Chair Powell didn't talk about in the press conference was QT. But QT is happening. We're seeing massive moves, and we want to have the liquidity to sell it when it's expensive rather than need to buy it when there's a challenge.
Lisa, is quote unquote increasing liquidity the same as go to cash?
Well, Kelsey, that's exactly what I was going to ask. How do you do that? Is it with ETFs? Is it with cash? Or is it with the securities that are most traded?
I mean, it is dependent on the portfolio. If you think at the very baseline, we're thinking about, going from off the runs to on the run treasuries, getting out of tips and into nominals, things that are going to have less ability to be intermediated when markets are quiet, when people are going out on summer vacation, and things are more likely to trade with more volatility. So essentially, the bond market has gotten much bigger, and dealer balance sheets have not risen to the same size to accommodate that. And so we want to be prepared when people need liquidity to be able to give it.
This is shocking to me, Tom, and really a reversal of what we've seen for so long when people were seeking out illiquidity. We are looking at the prospect of a Fed-driven volatility cycle that we have not seen in a long time in credit.
I'm just looking at I've been, Kelsey, this has been a crusade of mine, is we're in a bond bear U.S. aggregate bond portfolio. These are double-digit losses, right?
Absolutely.
What's the plan?
Absolutely. There's the two sides to that coin, right? You've seen massive losses, particularly in long bonds. The moves in yields, if I look at the move over the week or the move over the month and you compare them to the last 5 years, these aren't just 2 standard deviation moves. These are 4, 5, 6, 7 standard deviation moves. I mean, it's just incredible. But then on the other side, you have the yield, this new starting yield, if you were to invest fresh capital now, that is a lot more attractive. As Lisa mentioned, 8.5% on U.S. high yield is very attractive, and it's consistent with the long-term returns in the equity markets as well.
Yeah, we round up the digits, negative 13% in the U.S. aggregate portfolio. Kelsey, get to work. Kelsey Barrow with us with J.P. Morgan Asset Management, with Bob Michael working there in the fixed income space as well. Lisa, we can't say enough about this because it's all brand new to so many. It is an ugly year for fixed income.
It has been an ugly year for fixed income, which leaves this pivot point. Do people get out and solidify losses, or do they get in because they're actually getting real yield? Yeah, just hold, buy, and hold, the old coupon clipping that they used to do. How much are people preparing, though, for that volatility, for some sort of, I don't want to say credit crisis, that's too strong, but kind of what we're seeing, these gap ups in yields, price down, when we get some sort of withdrawal of the Fed's balance sheet. That, I think, is something I'm hearing more and more of.
We got a flighty tape. There's no other way to put it. The dollar's given away a little bit. The yen is having its first good day in ages, 132.75. Euro was a 103 print. We're now stronger euro, 104.34. I mean, Lisa, these are little moves. I don't know. Maybe we're overlooking at it too much.
I think that's the news. The news is that they're not massive declines or massive gains. People are trying to reset and looking for the next compass point. The fact that Jay Powell could raise rates by 75 basis points and people didn't necessarily view this as the world is falling shows how different of a scenario we're in, especially with the 50 basis point rate hike, also from the Swiss National Bank, which was expected not to move yet.
I noticed Mexican peso across the month of June, 4 standard deviations, -2 up to +2 is the move on weaker Mexican peso. We're going to continue through the day, an eventful Thursday, indeed historic, as the Swiss National Bank acts and the Bank of England maybe surprises, not 50 basis points, 25. Thanks to Guy Johnson in London for helping on the Bank of England. This is Bloomberg. Good morning.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Isn't it, just how sensitive the markets are to any commentary about trade? We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Thank goodness it's Friday. That's a joke, just a bit of British sarcasm, you know, before you start writing in and saying it's Thursday. I know. Futures are down 2%. Your countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue, a soft landing looking a little more elusive.
A big change from the Fed.
The question is if they'll be able to deliver.
Is there a path to a soft landing?
The Fed's forecasts are still remarkably optimistic.
All these numbers they threw out are fantasy land.
Can you thread this needle?
We're raising rates quicker than I thought we would.
It's going to be a very difficult navigating act to try and manage a soft landing.
Things are coming forward a lot quicker.
The balance between soft and hard landing is going to be incredibly difficult to navigate.
The market is having that same realization.
What we have is masses of inflationary pressures right now.
In terms of the Fed,
they are very much going to prioritize inflation over growth.
They're almost doomed to have to be more aggressive.
Joining us now is Morgan Stanley's Vishy Tripatura and Kathy Jones at Charles Schwab. Kathy, first to you. Your thoughts on what we heard from Chairman Powell yesterday?
I think it was pretty explicit in the information that we got on the SEP that the Fed is willing and probably resigned to the fact that we'll have a recession if they target headline inflation. So I think Paul tried to sort of dance around that message during the press conference. No Fed chairman wants to stand up and say, yeah, we're headed to a recession because we need to get the demand side down. But that was the message that I took away.
It's the message others took away as well. Wells Fargo said this: we now judge the recession next year as more likely than not. Vishy, do you share that view?
Right. I mean, I would say that the probability of recession has certainly gone up and has been going up for some time. So the risks to a recessionary outcome over the next 12 months is certainly substantial.
Kathy, I'm just going through the forecast, which previously you've called aspirational. I imagine you consider them aspirational now too. Which one is out of sync for you? And let me go through a couple. They've got the unemployment rate next year at 3.9%. They've got PCE back down to 2.6, and they've got the Fed funds at 3.8. Which piece of that do you think is aspirational? GDP print, they're expecting to be about 1.7%. Is there a piece of that that stands out more than others?
It would be the unemployment rate. I think we're already starting to see some softness in the job market. And remarkably, this is showing up in the Beige Book and some of the regional Fed write-ups that we've seen. So I'm a little surprised the Fed has that optimistic a forecast, because we are starting to see some loosening in the job market. We're hearing from companies that they have to lay off or certainly not hiring the way that they were. The hiring freezes are taking place. So if I had to put a number on the unemployment rate, it would certainly be higher than that next year.
So equity's down about 2% on the S&P this morning, at least going into the opening bow. Vishy, I just want to know what on earth to do with the bond market. At some point, a 10-year becomes a buy. Close to 350. Is it now?
I would say it's not yet a buy. I mean, given some of the uncertainty there, I don't think we are very far from being a buy. You know, our economists also revised their growth expectations. Our economists' expectations for the growth, 4Q over 4Q for 2022 is below the Fed's 1.4. And we expect the Fed to have a faster and more front-loaded hiking path than what they've laid out yesterday, the dot plots laid out. So I take both of those things into account, and I think that we probably would be close to a flat or potentially slightly inverted yield curve on the 10-year point. So I would say, it would be, we are not that far from getting the 10-year point to be much more interesting to look at.
Kathy, is it interesting to you yet?
Yeah, it is. So we've been suggesting gradually extending duration. We're not going all in. But I think that as the Fed moves to tighten, you'll see that inverted yield curve. And inevitably, with financial conditions tightening, we're going to hit some sort of peak rate in the long end. Now, the problem is that we have still sort of this embedded volatility. So we're going to get some of these spikes. But if I recall back to previous situations that to me this reminds me of, it's the early 1980s when we had massive rate hikes by the Fed to get inflation and inflation expectations down, and we had very sharp and short back-to-back recessions. And I think that could be what we're looking at, and that those were time periods when bond yields would spike up but then start to come back down.
Kathy, this is a piece of it, and I'm so pleased you brought it up, that I want to spend a bit more time on, not just today, but in the coming weeks too. Vishy, this R word gets thrown around so much, yet no one goes the one step further and talks about the kind of recession we could get, if indeed we get one. Can you talk to me about that, Vishy, that if we do get a downturn, based on what you see in this economy, what kind of downturn would it be? Where's the excess? Where's the leverage? What would it look like?
It's a very good question, John. I think we all need to dig into this into great depth. My expectation is that we do get into a recession. It will be a relatively shallow recession compared to the last two recessions we've had. And the nature in which this recession would come through and the framework at which this comes through is very different than the last two recessions as well. Especially, this could be a recession where we will see a pickup in corporate defaults, but not a spike in corporate defaults. So, in the last two recessions, the financial crisis and the COVID recession that we've had, we saw a pretty substantial spike, dramatic spikes in default rates. Here, I would expect that to be a much more muted because we are entering this at a very different point on the corporate balance sheets, as well as the household balance sheets. So this recession is going to be feel very different, much more. I think as Kathy's reference to the 80s is actually very pertinent. When in those early 80s recessions, we did not see dramatic spikes, or even in the 70s recessions, we didn't see pretty dramatic spikes in corporate defaults that we saw in the more recent recessions.
Vishy, with that in mind, as that develops, are you putting together some kind of playbook you'd think about? Can you share that with us now? What would you be looking to own? What would you be looking to avoid with all of that in mind?
We would be looking to own
more higher quality. So we would be looking to own more investment grade over high yield and leverage loans. And within the high yield complex, we'll be looking more towards away from loans, more towards higher quality high yield bonds within the high yield spectrum. And I think we'll also be looking at some of the lower dollar priced bonds, that have recently issued, maybe bonds that were investment grade bonds issued in the last few years that have taken a pretty substantial hit because of duration moves. And since we don't expect dramatic moves in duration from this point onwards, those are good entry points to find investment grade bonds in the $80 price or around there.
I'm going to try and work out what the next move is from the Fed before we get into all of this. This happened yesterday with Chairman Powell saying this: I do not expect moves of this size to be common. He went on to say, from the perspective of today, either a 50 basis point or 75 basis point increase seems most likely at our next meeting. Some doubt as to whether we get 75 or 50 at the next one. Barclays came out straight away and said this: we believe that the Fed will go back to a 50 basis point hike in July amid signs that consumption and the US housing market are slowing. Mike McKee, right on cue this morning, that data 38 minutes ago.
Yeah, the housing market's slowing, at least according to housing starts, which were down 14.4%. Steve Stanley, though, of Amherst Pierpont, points out that the total number is about what was expected because these are very volatile data. So it may be a little early, but it does look like things are slowing down. Here's the numbers you're going to want to watch every morning as you get up. What's happening with CPI, and the white line there is what the Fed thinks is going to happen with PCE. But it's that yellow line, it's the idea that the Fed is watching consumer expectations for inflation. If that keeps going up, you can expect the debate about 75 to get even more heated. Now, the Fed is going to be raising interest rates. We know because they moved the dot plot up significantly. And at this point, the real question isn't so much where they end this year. They're going to do another 175, they say, is where do they get to next year? How high is the terminal rate? Do they go over 4? 5 members of the Open Market Committee said they need to go over 4% to get inflation down. That's something else to keep an eye on. What are people going to be telling us about that? And then finally, you're talking about the recession. Here's the thing. The National Bureau of Economic Research is the ones who sort out whether it's a recession or not. And if you look at the indicators, and this is kind of a weird chart, I did this only to annoy Tom Keene, who hates a lot of lines.
Don't worry, he's on radio. You carry on.
But basically what it's showing you is mostly stable to up, the indicators that they follow to determine if there is a recession. And so at this point, it doesn't look like we are there. Now, you can project out what you think is going to happen, but that's just what it is, a projection. And as the Fed's found out, and Jay Powell admitted yesterday, projections can be wrong.
Hey, Mike, as we found out, too, I went through the sequence of things of the year so far. Do you remember when Ethan Harris of Bank of America said a hike at every meeting and people pushed back? Consensus. Then you had Andrew Hollenhorst who said 50, 50, 50, 50, and people pushed back, consensus. And for a moment, was it Jim Bullard in an interview just floated one out there about 75? And I laughed and I pushed back, and here we are, 75 yesterday. Mike, yesterday, I think you asked one of the most important questions at the news conference, and Chairman Powell struggled with it. And I'll boil it down to just one line that you mentioned. Is this Fed going to chase the price of oil?
Yeah, and that's the problem for them is what people are worried about and what people see every day is the price of gasoline, the price of food, things the Fed can't do anything about, and those are still rising. If that continues, then the Fed has a problem because it can raise interest rates all at once and it won't produce another drop of gasoline. So what do? That's Jay Powell's admission to that question was basically not a lot we can do.
They're in trouble, that's for sure. Mike McKee, thank you. And to Kathy Jones and Vishy Tripator, to you guys as well, thank you very much. You're going to be sticking with us as we count you all down to the opening bout with equity futures negative and bond yields higher, a whole lot higher. Let's get you some moves ahead of the open. Let's say hello to Abby. Hey, Abby.
Hey, John. Well, that Powell pop from yesterday's meeting, it certainly has faded. We have U.S. futures down sharply, as you were mentioning, down about 2%. Interesting, right around where we were ahead of the Fed meeting. So a lot to do about nothing, but not a lot of actual change so far. But that means that the big tech rally that we saw yesterday after that meeting, it has faded too. Apple, NVIDIA, Applied Materials, Tesla. So a wide variety of tech names lower as yields are higher, although again, again, kind of where they were ahead of the meeting, but that means that valuation and concerns of more expensive everything weighing on tech and weighing on the futures going into the open, John.
Abby, thank you. Coming up, the president, the White House, has a problem at the pump.
He is open to all reasonable uses of federal government's tools to increase output and lower cost at the pump, including emergency authorities like the Defense Production Act.
That conversation up next.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Already, the president has demonstrated his willingness to use that emergency powers to lower costs for families. We're saying that the president has used it before, and he's willing to do that again.
The White House signals it's open to using emergency wartime law to increase gasoline output. This coming as Exxon responds to President Biden's call on big energy with a suggestion of its own that said the following: the U.S. government could enact measures often used in emergencies following hurricanes or other supply disruptions, such as waivers of Jones Act provisions and some fuel specifications to increase supply. Joining us now is AMH down in D.C. Anne-Marie, that letter went on to say and concluded with a really, really important line. Longer term, government can promote investment through clear and consistent policy that supports U.S. resource development, such as regular and predictable lease sales, as well as streamlined regulatory approval and the support for infrastructure, such as pipelines. This is the disconnect right now, isn't it?
Yeah, and it's not just Exxon, Jonathan. Very, very late last night, we got a letter as well from Chevron. I'll bring you a little bit of that. Chevron saying they understand the significant concerns around higher fuel prices currently faced by consumers around the country and the world. We share these concerns and expect the administration's approach to energy policy will start to better reflect the importance of addressing them. Here's the zinger. Quote, unfortunately, we have seen since January 2021 are policies that send a message that the administration aims to impose obstacles to our industry delivering energy resources the world needs. Clearly, the oil industry has got the letter from the president, and what they're asking back is a bit more clear policy. Do you want this to be an industry that flourishes in America, or do you not? That's really what it comes down to. And when you look at what the president can do in the short term, they're going to need the industry for that help. You have the press secretary talking about the Defense Production Act. What does that actually mean? On the margins, what can the president do? There's not really a whole lot of refineries you can just start overnight. So this would take a lot of capital investment and encouragement from the government.
So what are you focused on, Anne-Marie? You focused on what they can do domestically. They're constrained somewhat. What they can do on the international stage, a visit to, say, Riyadh, catch up with the Crown Prince Mohammed bin Salman. What can actually address some of this, alleviate some of the pain ahead of the midterms, which, let's face it, that's the political one they're focused on.
Right. When they wake up every day, Ron Klain is checking, the AAA gas price the same way I do, and it's average of $5 a gallon right now. So we should break it down to two parts, Jonathan. One is the global oil market, right? Obviously that there's been constraints there coming out of a pandemic. There's a lot more demand that's needed, not enough supply, and then it's exacerbated completely by taking out the super commodity store of Russia. So yes, the president is going to go to the kingdom. We've already seen an olive branch by Saudi Arabia in the last OPEC Plus meeting to boost production. Potentially, there could be more there in Saudi Arabia after the president makes this visit. But Saudi Arabia alone, the UAE, these two countries that have spare capacity, that will not solve $5 a gallon gasoline by itself. The other issue, what the president's letter was addressing, is refining capacity. Spare capacity for that is in China. The United States, it's going to be very hard to try to get more refineries. These require long-term investment. They were struggling before their pandemic hit. Mike Wirth, earlier this month, said to Alex Steele he cannot see another refinery being built in the United States. So this is the problem this administration has. First, you have to get more oil. Second, how are you going to turn it into products? It's a huge struggle, and it will not be fixed before November.
It's a big, big ask. AMH in Washington, thank you. And it could get a whole lot worse. Take a listen to Jeff Curry of Goldman.
Markets move faster, and the fundamental tightness is deeper than what we would have thought 3 or 6 months ago. This is where we should be, but it's a lot deeper than what we would have initially thought. Energy and food right now, as we go into the summer months, is severely skewed to the upside.
Kathy, is this Federal Reserve going to keep on chasing what's happening in this commodity market?
It's a real conundrum because they can't have any influence on the supply side, especially in food and energy, and yet they seem focused on bringing demand down to meet that limited supply. And if it continues to do that, we're going to see a recession, and we're going to see it sooner rather than later. So I hope that policy isn't just focused on gas prices, but I do know that it works its way into inflation and inflation expectations. So they're really caught in a rough spot. I think they'll try to navigate this as best they can. But it seems if the Fed is determined to just focus on headline inflation, then there's nothing left to do but keep raising rates and squash demand. And that's not a good scenario for the economy.
I'd go a step further as well. I think it makes it all even more unpredictable. Vishy, let's just talk about it. You've got energy, which everybody is terrible at forecasting, influencing inflation expectations, which the Fed is determined to respond to. With that in mind, Vishy, how predictable is it when you start to think about what the Fed's going to be doing beyond summer, if so much of it is dependent on what happens in the energy market, because that is what's influencing expectations?
It definitely puts the central bankers, not only the Fed, in a bind. Our expectations here is that the Fed will deliver another 75 basis point hike in the July meeting. We continue to see upward pressure on the core CPI from the data in hand, as well as some of the work that that you can get on using the CPI fixings market. And thereafter, our economist, our U.S. economist, Alan Zetta, thinks that 50 basis points through November, in these two subsequent meetings, and final 25 basis points hike in December. This is, I do think that the inflation fighting is at the top of priorities for the Fed, and the playbook we expect that they will continue to follow is front-loading the policy shocks.
Vishy, thank you, sir. Vishy Tripatur, alongside Kathy Jones of Morgan Stanley and Schwab, respectively. I've just seen something on the Bloomberg that I don't think I've ever seen covering the ECB for a long, long time. Listening to the Italian central bank governor put a level on the Italian-German spread. He's done this in the last 30 minutes or so. So just quickly work the Bloomberg for you. The Italian 10-year versus the German 10-year. That spread right now about 200 basis points. Last year it was inside 100. The peak in the last few weeks, 242. This is what Visco had to say. The Italy-Germany spread should be 150 basis points based on the economy. The fragmentation, the so-called fragmentation, and when they say that, they're talking about Italy and the periphery and what happens in the bond market, impedes monetary policy, and the recent increase in spreads is unjustified. This is the pushback you're starting to see in the bond market. What I've been surprised by is that you've got a central bank governor, in Italy of course, making the case for 150 basis points. So you've got central bankers now telling you where they think the price of the market should be based on the economy. And you've got the Italian central bank governor saying it should be 150 basis points based on the economy. Go figure. We're at 202 basis points right now, 52 basis points north on that spread. But this is the conundrum, the dilemma for this ECB, this central bank at the moment. They're trying to increase interest rates. They're trying to tighten financial conditions, but not too much. That means we get fragmentation in the bond market, which ultimately impairs monetary policy and means they have to back away. The dilemma for them is, how do you achieve both? How do you achieve higher interest rates without sparking fragmentation in the bond market? And therefore, if you have to step in, how do you make sure that you don't ease financial conditions? I just think it's bizarre that we've got an actual central bank governor in Europe right now trying to put a price on the market to try and say that this is what's justified. And I wonder if they're backing themselves into a corner now, because any vehicle they have to come up with ultimately, is that the lid that they're trying and keep on spreads? One to think about. Up next, your morning calls, and later, investors repositioning after a big interest rate hike at the Federal Reserve. Sam Linton-Brown at BNP coming up. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Five minutes away from the opening bell, equities lower by more than 2% on the S&P, and the Nasdaq 100 down by 2.6%. That's the price action. Here are your morning calls. First up, Jefferies downgrading DuPont to hold, turning cautious on chemical stocks amid rising interest rates. Citi upgrading Boeing to a buy, seeing limited downside, even if near-term headwinds last longer than anticipated. That stock is lower by about 1.5%. And finally, Morgan Stanley upgrading Dollar General to overweight, favouring defensive stocks as the likelihood of a recession keeps growing. That stock is unchanged. Coming up, BNP Paribas' Sam Linton-Brown said it's time to buy stocks. That conversation up next, your opening bell, just around the corner.
Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. Earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
24 seconds away from the opening bell with equities down this morning. Good morning. The S&P 500 looks like this, down by 2.3%. On the Nasdaq 100, down by 2.6%. On the Russell, down by 2.3%. Yesterday giveth, today taketh away. That seems to be the theme this morning. Switching yesterday almost upside down is yesterday in reverse. Look at the bond market, it's the same thing. Yields up 15 basis points, 3.43% on a 10-year. In the FX market, euro dollar trying to hold on to 104. Positive now by a couple of tenths of 1%, 104.62. And crude, negative 1%, 114 on WTI. About 15 seconds into this, we're negative 0.6% on the S&P 500 around the open. Real estate down by 1.9%. Housing starts this morning, ugly. Information technology down 2%. Consumer staples down 1%. We're down 1.99% now as more stocks start to get open and we get those prices down about 2% on the S&P 500. Should we get you some movers? We can do that with Abby. Hey, Abby.
Hey, John. Well, we do certainly have stocks sagging here on the open. A lot of those heavyweight techs really weighing in a big way. I know Ed will be looking at that more closely, but we have a lot of inflation-linked stocks that are down sharply, too. Kroger, the grocery store company, it is down 3.6%. This as margin pressures way overshadowing a pretty solid sales beat. Not surprisingly, that is a story we're hearing over and over. Gross margins of 21.6%, 40 bips short. Rising costs eat into their profits. Now, ExxonMobil, this is interesting, down 2.5%. A lot of markets are exactly where they were yesterday, ahead of the Fed. But oil is actually lower. That's a positive, perhaps, for the consumer, but for big oil, not so much. So you see those shares lagging and sagging. Ford down 3.9%. This after those weak retail sales a couple days ago, really highlighting the drop in car sales. But also they have shared that they are losing money on their Mustang EV SUV. Some are also saying that Ford and GM are preparing for a recession. And then finally, a possible bright spot here, Twitter, John, a stock that we love to follow. Elon Musk, of course, is speaking to the Twitter staff for the first time. They, of course, have learned that their Disneyland trip in January is canceled for cost cutting, but Elon Musk speaking, traders, investors liking that as a sign that maybe the deal goes through. I would point out, though, John, that spread about $15 between where the stock is now and the price that was offered in mid-April.
It's still pretty wide, isn't it? Abby, thank you. About 2 minutes in, we're down by 2% on the S&P 500. Everything negative. Staples even negative 1.2%. Discretionary down by almost 3%, off by 2.86%. Looking at information technology, down 2.5% on the West Coast in San Francisco, where he resides. Bloomberg's Ed Ludlow. Morning, Ed.
Yeah, good morning, Jonathan. Looking on the MOV function
on the Bloomberg, on the NASDAQ 100. You look at Apple, Microsoft, Amazon, Tesla, not just the biggest points drag on that index, but down serious percentage point declines between 3 and 4% in some of those names. I have a sense of deja vu, and I think you were discussing this yesterday on Fed Decides. How many times have we had a Fed meeting where in the session stocks rally, particularly the technology sector, and the following day we see a heavy sell-off because everyone goes to bed, yields rise overnight, exactly like we saw in the last 12 to 24 hours, and technology sector has some pain in the following session. You look at that chart, that is the story right now, but really, reading across the Bloomberg, we've moved from the narrative where higher rates discount the present value of future profits to recession fears, and we go back to what we learned in earnings season. This sell-off in risk assets also, of course, extending to Bitcoin, which I'll give a quick shout out to. We've traded kind of sideways over the last few days, but over a longer duration, this is a really big drop. And I was interested to listen to the comments of Scott Maynard of Guggenheim yesterday, John, saying to you that this is not a diversifying play. This is a risk asset, just like everything else. And the declines we saw in Bitcoin should have been a leading indicator for investors of what was to come. Really interesting forward insight from him.
That's something Scott said, that this doesn't bottom the equity market until that does.
Exactly.
Bitcoin. Ed, let's catch up on Twitter in just a moment. I think we've all learned that lesson over the last couple of meetings, just never to define the Federal Reserve meeting by the post-Fed price action, the intraday moves. We talked about that yesterday, even with those massive moves. We need to catch up with Taylor Riggs. Taylor Riggs, that rally evaporated pretty quickly.
It did, John, and you're right. We sort of all learned our lesson. We learned that yesterday at the closing bell, too, right after your show there. And I think what's interesting is, you think about sort of the revisions downward and where we are with some of the strategy targets. The average, we're now down to about a 47, 43 from last month, off almost 3% to the median, as you can see there, at about a 46.50. I don't know if this is the JP Morgan note that just came out that equities are now pricing in 85% chance of a recession, or if this is just the basic higher yields means that we lowered the net present value of what equities are worth today. Either way, you're starting to see some of these price targets come down just a little bit. I think what's so interesting, and our producer, Pete Diartoris, has done a lot of good work on this. If you've been super bullish or super bearish, you're sort of holding to your guns, if you will. But it's sort of the guys in the middle. 7 out of 30 respondents in the last month, or about 30%, are cutting their outlooks. You're starting to see some of the guys in the middle in the squishiness there, bringing down some of those price targets here as we sort of reevaluate where we are. The big question, John, has always been, what is defensive in this market? In the pandemic, it was tech. I think we're slowly learning that maybe the new defensive isn't technology, it's the opposite. This is high growth minus defensive. And you can see that growth is really the big underperformer now for 7 straight months relative to some of the defensive sector. But what is defensive? Is it dividend stocks? Is it cash, which gives you that optionality? That sort of is the new big question.
Cash, as Tom has been telling us for years, through the whole of the bull market. Cash, apparently, triple leveraged. You know the story, Taylor. Taylor Riggs, thank you. Let's catch up soon. Someone's bullish. I found them. It's Sam Linton-Brown over at BNP. Says this: we're positive on equities. They already priced too bearish a cyclical outcome. In our view, a hard landing is not predetermined. Sam, I'm pleased to say, joins us right now. Sam, the floor is yours. Give me the bull case right now.
We've had a derating in the S&P that we've seen twice in the past 30 years, each of which has occurred in the midst of a US recession. In Europe, the market already prices in an earnings contraction that we think is only compatible not just with a recession, but with a prolonged recession that feeds through to the labor market that leads to corporate defaults. If we look at Fed pricing, the timing of the first cut once the Fed end the cycle in terms of hikes is quicker than is typically the case. And if we look at the dollar, it trades rich even versus those other cyclical negative points I just pointed to. So our medium-term view is that we're in the zone of peak hawkishness. A hard landing is not a predetermined fact, and therefore that on a medium-term basis, this isn't a bad level to be positioning low-risk assets.
Sam, what kind of landing are you anticipating? Just to jump in, can you tell me what kind of landing you are anticipating?
If you ask that question to our chief global economist, he'd say it's a soft-ish landing. Now, it's not a soft landing, was clearly not anywhere near a Goldilocks-style scenario, but it's a landing where we think a global recession can be avoided, which we'd argue is different to what the market is now discounting. Now, that's the medium-term view, but I think clearly one needs to acknowledge what's happened in the past few sessions. And the market's very much perceiving that what we're seeing here is a coordinated, accelerated pricing in of central bank tightening cycles. Forward guidance is out of the window. It's all about data dependence. And that really does inject an additional uncertainty. And so it means that in the very near term, independent of your medium-term view, one needs to be, if you like, quite humble and nimble and lightly positioned.
Sam, before people buy this market and get more bullish, are you comfortable with earnings revisions? Do you think we've seen sufficient downgrades on both the analyst side, but also from corporations to come out and say, this is what we think is going to happen, we're cutting our outlook? Have we seen enough of that?
It's a question of what the market is pricing relative to bottom-up analyst expectations. And that's where you have an absolutely huge discrepancy. Europe is a good example, where after the Q1 earnings seasons, forward-looking expectations in Europe were revised up over the same period in which Euro stocks went down 10%. So the level of earnings growth that current prices reflect, here you have to make some assumptions on normal levels of equity risk premium, are such that the market already is pricing, especially in Europe, a very significant earnings recession. So I'd argue it's more a question of if the market has already discounted a very different backdrop to what the analysts are expecting, and our answer to that would be yes.
So this raises an important question. If you are constructive, the parts of the market you want to be buying, Sam, and holding over the medium term, where is it? Where are you comfortable stepping into? And more importantly, I think also, where would you want to avoid?
In this type of environment, like I said, one has to do it in quite a humble and a nimble way. So in US cyclicals, we like positioning through 1x2 call spreads. The reason this is attractive is if you're wrong, you don't lose a lot. And it sells what we refer to as the right tail, the big upside potential in US equities that we think is unlikely, because even if the market does perform well in line with our expectations, the Fed reaction function is such that we've gone from being long a Fed put to being short a Fed call, i.e. the right-hand side tail, the big upside of risky asset returns is capped, and therefore we like 1x2s there. In Europe, I'd say financials is an attractive place to be positioned. We've seen, and perhaps we can talk more about it, this rhetoric from the ECB that's shifting the dynamic there on spreads. And given how cheap financials trade relative to the level of yield, that's an area we also think can recover. In FX, the Australian dollar, we think, is poised to outperform on a broader recovery in risk sentiment. And I'd also throw in somewhat counter consensus that the euro could be basing around these levels.
Oh, Sam, some of that is our consensus. We've got to talk about the banks. You're a brave man. Are you ready to step into the European banks, given what's been happening with Italy, and given that the only thing we have from the ECB is a plan for a plan, and not actually a plan that they can engineer and use anytime soon?
Plan for a plan. I think you put it well. But the broader question I'd say is, look, the market needs to be convinced that the ECB has spreads under control. And I think there's been a pretty big development over the past 48 hours in terms of calling that emergency meeting, making it very clear that it's not just that a backstop is being discussed, it's that it's effectively already been agreed and that an announcement could be imminent. And we've even seen in the past 30 minutes the officials out of Italy going so far to put a specific level where they think that BTP spreads should be traded. So our view heading into this year was bearish EGB spreads. We'd advocated to be positioning for Bund BTPs to widen. We had a 230 basis point target on that trade, and we took it off as it hit that level. And perhaps the path for spreads could be a little bit wider from here because the market has retraced so sharply. But I think the broader question is, will the ECB allow the market to price fragmentation risk? We think the answer to that is no. It doesn't mean they'll immediately be successful in their aim to prevent that, but ultimately we expect them to be. And if they are, then these types of levels in, I'd argue, both euro-dollar, but also in Eurozone financials, are sufficiently cheap that risk-reward's attractive to be long.
Sam Lindsay-Brown, that's some brave stuff. You're going to stick with us. We'll carry on talking about it. We're going to do a segment on the ECB and we can dive a little deeper into this stuff. Sam's going to stay with us. I want to touch on what's happening with the Tesla CEO, Elon Musk, as well, holding this meeting with Twitter employees. I want to cross back over to Ed. Ed, just get us up to speed on what we can expect today.
Yeah, so Elon Musk is going to do a virtual all-hands with Twitter staff. I'd note this is pretty normal, right, in a deal scenario. This is not a normal deal scenario, but when deals are normal, then the acquirer will often address staff as the deal proceeds. Twitter staff are being invited to submit questions, according to sources, and they basically have three top questions, John. Is this deal going to happen? Fair enough. They also want to know a little bit about Musk's political stance, which is interesting. You know, many Twitter staff are left-leaning, San Francisco liberals. They don't agree with Musk's politics. And then the third is kind of things that impact them, right? Compensation, Musk's work from home policy. Twitter has an indefinite work from home policy as it stands. Lots of these staff want to know, will this change?
Ed, thank you. Ed Ludlow on the West Coast on top of the Twitter story. He'll stay on top of that through the day on Bloomberg TV and Bloomberg Radio. Yesterday, we had a 75 basis point move from the Fed. This morning, we had a 25 basis point move from the Bank of England and the first rate hike from the Swiss National Bank in 15 years.
If you look at our inflation forecast, it clearly shows that inflation is now higher.
A 50 basis point hike from him, and that conversation is just around the corner.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We believe it was necessary to increase rates today. If you look at our inflation forecast, it clearly shows that inflation is now higher. There's also a certain risk of second-round effects, a certain risk that inflation does not come back below 2% by itself. And so we came to the conclusion that it's now the right time to make a certain adjustment of our monetary policy and to tighten.
That was the Swiss National Bank. They went 50 basis points. The Bank of England followed. They went 25, and the committee wrote in a statement the following. The committee will be particularly alert to indications of more persistent inflationary pressures and will, if necessary, act forcefully in response. So what have we had? 75 basis points from the Fed, 50 from the S&P, 25 from the Bank of England, and 0 from the ECB. Maria Tadeo joins us now from Brussels. Maria, they've got a plan to make a plan, and we got some reporting and some comments from the Italian Central Bank Governor too.
Look, I knew you were going to ask me about the Italian Central Bank. Ignazio Visco, of course, he was asked about this fragmentation in the market, about the risks potentially to the Italian economy, and he was very clear. You know, he was asked what is fair value, and he said 150 basis points. That is the fair value of an Italian 10-year BTP and a German bond. Everything else that you see, including, of course, the big blow-up that we saw at the start of the week to 150 basis points, is extra fragmentation, and that means her monetary policy is not only not working, but it's also penalizing Italy in a way that he would consider is unfair. Now, a lot of this, Jonathan, you can have many opinions, but he's not the only one that would tell you this in Italy. The Italian government, many Italian officials, they all argue the market looks at Italy like the basket case that it was potentially maybe 10 years ago, but they don't notice and they don't price in that this is Mario Draghi, that this is a very different leadership, that there is funding coming from the European Union, and that, of course, the reforms will begin to kick off. But the reality is, where is the growth in Italy? Ultimately, that is a big challenge for the country. All of this, I have to say, too, really increases the stakes going into the meeting in July. And Jonathan, yesterday you asked me, when are we going to get this tool? Well, what we hear now is that the European Central Bank really wants to get the anti-fragmentation tool ready to go by the July meeting. And the thinking here is that, on the one hand, you take rates higher, that is very well calibrated, is 25 basis points. And on the other one, you announce the anti-fragmentation tool and hope that that will create a sense of calmness in the market and not create a lot of jitters as you hike. That is a hope of the central bank. Whether it works, well, we'll have to wait and see.
Maria, thank you. Maria Tadeo. We're lucky to have Sam Linton-Brown and BNP Paribas with us because he's got a very different view on Europe. I think almost out of consensus. In fact, I would say out of consensus. Constructive on European equities and the banks in particular. Sam, let's talk about this. The most effective bond market backstop I've ever seen, I think most of us have ever seen, was President Draghi's whatever it takes, and ultimately a plan that never even had to be used. He didn't have to buy a single bond for it to work. This time around, with inflation as high as it is, and an ECB hiking rates, not cutting rates, I do wonder what needs to be done here. For you to be constructive on the European banks, have you got a really strong idea that you have confidence in of what this ECB is about to do?
It's interesting you mention inflation as a channel here in the way the view's formed, because I think it's actually a very important and somewhat nuanced point with respect to the debt sustainability concerns that the market's trying to trade in Italy. Higher inflation, to the extent that it's going to lead to better nominal growth in Italy, which it's highly likely to, will actually make the primary surplus required for debt sustainability metrics to look reasonable, actually much more attainable. So from that channel alone, it's actually somewhat counter to what people tend to think, a positive factor for Italy. And I very much agree with the comments from your colleague that the market's trading this with a different perception of the political backdrop to what we've got today with Mr. Draghi in charge. In terms of the ECB, what we're expecting is that the backstop will be announced imminently, that once that backstop's announced, the market probably will assume that a July rate hike is likely to come with greater certainty of 50 bits rather than 25. And therefore, you'll have quite a powerfully bullish combination for the euro, where you'll have core yields repricing higher still, but that being accompanied by stable spreads. And that isn't what we've had so far. And that combination of factors, we think, can support euro-dollar from these very depressed levels, which it currently trades at.
Sam, that's a centrally planned market, isn't it? Is that essentially what you're expecting the ECB to engineer here?
Some thought that that was effectively what was happening with next generation EU in 2020 and in 2021. And I think the market's expectations on that can flip very quickly. They'll begin to buy in again to this narrative that debt in the Eurozone to some extent is mutualized, and that the ECB simply cannot allow the transmission of monetary policy to be impaired by the market trying to trade fragmentation risk. And ultimately, like people often say, don't fight the Fed, we'd say on this one should not be fighting the ECB. Now, that doesn't mean that spreads need to tighten materially from current levels. It's more the pace of the move and the disorderly impact that's been having on the market that needs to stop. So our target for Bund BTP spreads for the end of this year is wider than current levels. We think they go to 260 basis points. But provided that's a move that happens in a relatively orderly fashion, we think it's a move that's insufficient to hurt European risk assets in the currency.
Well, they're getting hammered right now. Sam Linton-Brown of BNP. Sam, it's great to catch up and get your perspective on things. It's a brave call, and if he's right, I think we should all give him a round of applause. But right now, it's a difficult call. The DAX is down by more than 3%. The FTSE 100 is down by 3%. The Nasdaq's down by 3%. The S&P 500 is down by 2.74%. That's the equity picture. I'll give you the bond market story. Yields were down yesterday. They're higher today by 9 basis points. The housing data was dreadful. Your 10-year yield's up by 14 or 15 basis points in the US to 343. Coming up, the market moving events you need to be watching. Your trading diary is up next. Last year on the S&P 500, we were up almost 27%. It's all gone. It's all gone. We're negative by 2.7% now on the S&P 500, wiping out last year's gains. On the Nasdaq 100, we're down 3%. That's the equity story. Bond market picture looks like this. Yields are still climbing, still breaking out on 10s. Your 10-year close to 350 earlier, 342.34, up 14 basis points. On a 2-year, up 7 basis points to about 326.72, even with some weak data a little bit earlier this morning. That's the price action. Here's your trading diary. Another Bank of Japan rate decision coming up on Friday. That's going to be interesting. Plus, we'll hear from the Fed Chair, Jay Powell, too. More Fed speak from Governor Waller on Saturday. Next week, U.S. markets closed on Monday in observance of Juneteenth. And finally, a host of Fed speak throughout the week. Mester, Barkin, Powell, Evans and Harker, all over again. Wow, what a couple of days we've still got to come through today and into tomorrow. This was the Countdown to the Open. Thank you for choosing Bloomberg TV. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sci-Fi stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it.
Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.